Okay, welcome to the BA4 Business Analysis. This part 4. Okay, will be conducted by Mentor Kin Lim. Although this is part 4, all right, but for the series of 4 courses developed by Mentor Kin Lim, there's no need to follow the sequence. Right, but this particular part 4 is actually, I would say, beyond what you have learned. For example, you probably have learned company with a good FA. You thought, wow, good FA must be good. Then you forgot what Dr. T shared with you. All right, the 80-20 rules. Although the simple 8FA could achieve in general like 80% satisfactory business performance, but there's still remaining 20%. There's a potential loophole, potential risk, potential time bomb. So that's why Mentor Kin Lim is actually very aware of it, and he explored various areas of such potential red flags and gather them and compile them in this course together with his experience identifying all these risks in the market. He'll teach you how to avoid them. Without further ado, I'd like to invite Mentor Kin Lim for this course. At the same time, if you have any question, you can type in the chat box from time to time, and Kin Lim will find like a good break, then we'll reply to you. Is okay? All right, Kin Lim, go ahead.
Okay, thank you, Dr. T. Good morning, everyone. Welcome back. So today is a BA4 course. As what Dr. T said, this course is slightly more advanced than average because we will be touching on we are looking at the footnotes of the company's financial statements. What are the things that we need to be aware? So that's why the title course Beware Business Red Flags. We'll also be looking at the fundamentals. What are the things that can lead to decline in the share price in the future, so that we can prepare ahead, or we cut loss ahead before there's a bad consequences, a bad event coming up. So without further ado, let's begin. Disclaimer: whatever I share here, whatever case study I present here is for your own education. There's no buy or sell call. Okay, what is the course objective for today? So today we will learn how to detect hidden red and yellow flags in the financial statements and company disclosure. And we analyze the footnotes for the signs of asset overstatement and accounting manipulation. Interpret key financial ratios to assess the true profitability and risk. So we'll be looking at a few financial ratios. What are the key important financial ratios I use frequently to check the risk of the company. Spot early warning sign before the company share price or performance declines. Understand why strong headlines number, as what they say, strong AFA, can be sometimes be misleading for some companies. Usually, companies with AFA are okay, good AFA, but there are some companies, they try to protect themselves good in front of investor, but let's say you dig deeper, then you will find some rotten apples behind. Apply business analysis with real world case study of a major company. So we'll do some case study, of course, at the end of the day, and protect your portfolio by avoiding common investment pitfalls. So these are the list of my objectives for the course today. Okay, so as you can see here, I put on the left hand side, what investor usually sees is that company try to portray you to you strong headline numbers, strong reported sales, strong earnings, strong balance sheet, good relative, attractive dividend yields. So that's why we buy into those company. It looks very good, but at the other side of the tree is already burning. It's already in the fire. So So we need to look at the whole the whole picture. On the other side of the tree, you can see here, uh, we are able to detect there's actually red and yellow flags in this company, or asset overstatements, accounting manipulation, some deterioration in the economy mode, contingencies, and worse, the company managements try to siphon our capital out of the company for their own benefits. So in this course, we try to look at these attributes, these items, item by item, so that we learn this skill. Hopefully, if you learn this skill in the future, you can apply in whatever case study in you or whatever potential investment you want to make. Okay, as what Warren Buffett said, it's good to learn from your mistake, but it's always better to learn from other people's mistake. So this course is to is designed such that we can learn from what are the past mistake uh, from making bad investment. Uh, so what are the attributes to those bad investment? So we in this course it is designed for us to learn from other people mistake and to learn from other investment pitfalls. And this gentleman also say, learn from other people's mistake. Life is too short to make them all yourself. So life is too short. We, as much as possible, we want to take a safer route and the path of least resistance so that we cover them all. Especially let's say you make like 5-digit or 6-digit investment uh, uh, position. It's better to check all these. That's my recommendation now to check whether the company has a red flags or yellow flags behind. Okay, questions to be addressed in this workshop that what methods can we use to assess whether a business model is not sustainable? In what ways might a business artificially boost their revenue? And how can we identify if a business is creating fake or misleading profits? And how can an investor tell if a company's reported profits are of poor quality? What are the early signs typically precede drops in the company earnings and share price, stock price? And how should we interpret the company balance sheet and types of the asset it holds? And what are the implications of if the business holds substantial contractual obligation and potential liabilities? And what evidence indicates a company dividend payments are unlikely to continue in the future? And what signs suggest the company is extracting wealth from its shareholders? So we will answer this question one by one later on. So today course is a bit intensive. So some of you are uh, just starting to go to investing, and then I think this course maybe what you can do here is you just listen first, and then in the future you watch the replay many times, and you to catch what I trying to tell you, because this is a bit slightly more advanced to look at, because all this course is is a compilation of my past experiences and my learnings from various mentors and also various fund managers. Then then I think, because we always look at the good side of the business, but how about the bad side? How can we reduce our risk? So this course, I want to design this course so that everyone can benefit, so they can avoid making losses, investment losses. Okay, I have 4 series of courses. Each of these courses are distinct, are unique in nature. The BA1 is more on the very basic courses. It's more on talking about financial numbers and business models, economic mode analysis. BA2, we'll look at company management. We'll do how to value a business. BA3, which is the next course, we'll look at industry analysis. We look at some the list of the key industry I'm interested. I will share what are the things I pay, what are attributes, what are the financial ratios for this industry that as an investor we should look at. But also I will share what are the attributes for other industries. So in today we'll talk about the red flags in the businesses. Okay. This is just a sharing uh a, separate slide I wanted to share with you. So to let's say someone approach you, there's a potential investment, uh, potential ideas, and it tell you that paint a very good picture. This company can make a lot of money, guarantee you good return. It's always good to go to this website. The MAS is a Monetary Authority of Singapore, Central Bank of Singapore, and to check whether those company are in the investor at risk. I always check this. I always have a opportunity coming from my friends. Hey, look at look at this investment. Is a very good return. I always what I will do, I will go to this link and I check whether those companies that guarantee you good investment return are in the red, are in the alert risk by MAS. It's always no harm to check this. It's always important before you make a lot high investment. Okay, so this gentleman is from a fund manager from India. He said why accounting quality screening. He said in India, right, 40% of the companies of the large cap companies exit the index over the 10 years due to accounting issues and capital misallocations. So in his framework, his book, his cover, how do we uh do the income statement check to check whether the company manipulated the sales revenue and earnings? How do we do the balance sheet check? And how do we do the cash flow statement check and cash theft check and auditor check? All this. So after by you applying his framework, like out of 500 companies, only left with quite a few companies, 30 to 50 stocks can be investable or can be invested. So in this course, not to worry, I actually incorporate some of the wisdom and some of the lesson uh, from this book so that everyone here can benefit. Okay, so first thing first, why we need to check the auditor opinions. So auditor of the company, of the listed company, issues three types of opinions or disclaimer. They are unqualified, qualified, adverse, and disclaimer. Unqualified means things are all good. Auditor thinks that the report are fair and accurate. A representation of the company uh, financial conditions. Uh, Qualified means things are not so good. Some area auditors did not agree. Adverse, things are not good at all. Auditor did not agree with the report. And disclaimer, this is worse. Auditor cannot give you opinion. It's removing itself from what is reported in the financial statement. So what you need to do whenever you look at a company is very easy. You will just search for the keywords opinion or true and fair or fairly. As long as you can find these true and fair and fairly, I think you're in a good shape with this company, huh? So of course, when reading tenor of the reputation of auditors, how uh uh mm, what do you call it? Big four auditors should be okay. Mid-sized firms should be okay. But as long as you need to check, those auditors are reputable and do not have any scandal, in the past. Uh, when auditors give a qualified opinions, watch out, and when the auditor suddenly resigns, it always it is not a good sign. They suddenly change the auditors. So out of these four, we only look for unqualified opinion. The rest, the other three are we should whenever you look at this, we should skip start looking into the company in details. Okay, for as example, this is a listed company in Singapore or Chengki. You can see here, you search for the keyword opinion or true and fair, then it will give you. So the what Old Chang Kee auditors say that their reports, financial statements, uh, are, are the true and fair view, representation of the financial position. This is what we want to see. Another listed company in Singapore, Sakae, yeah, gave a qualified opinion in 2014, as you can see here, highlighted in bold here, qualified opinions. So this is no good. So that's why this company always have a qualified opinion. Disclaimer, qualified opinion. The share price keep declining. So even though they change the audit, I'm not sure whether they have changed the auditors, but I think the management is still the same. So I don't like to I don't like this company lah, because always the accounting statement cannot be really trusted. So another company, Yuju, disclaimer opinion. So as you can see here. Yeah. So CEO quits, company are able to continue Singapore operation due to trading suspension. This company is no more lah, no more in Singapore. Okay. The other thing is a part of auditor's opinion. Something more we can look at is emphasis of matters. So auditor believes that there's a need to draw user attention to significant uncertainty surrounding accounting estimate. Uh, so this usually happens when the company is making negative cash flow, or there's a cash flow quality within the company. They not sure whether in the next few quarters they have enough cash to cover their operation. So in those companies, usually auditors will pre-warn investor. So they see something you need to take note about their cash flow. So what you can do, you will just search for the keywords, emphasis of matters, and read those uh, opinions or statements from the auditors. So there's some going concern assumption. Prior or previous financial statements contain material misstatement. Financial statements are prepared under special purpose framework, an event that may significantly affect the financial position of entity. Search for the keyword going concern and or emphasis on matters. So look for those. So as you can see here, this Lipo Mall REIT listed in Singapore. You can see here the emphasis on matter, and you can also find the going concerns. So auditors have some concerns on this company. When I look at this, as much as possible, I try to avoid investing in those company. Let's say you want to invest in this kind of company, make sure it's not big part of your portfolio. Maybe you believe in the company narrative. They are going to make it in the future. They can turn around their business, or their product is going to be uh, uh, go, going to take off much more in the future. So, but not make sure as much as possible, try to reduce your risk. So this another company from listed in Singapore from China. Emphasis on matter, there's some going concerns, going concern on the subsidiaries, their ability to generate sufficient cash flow from the operation to meet their current and future obligations. Usually cash flow problems, company that has cash flow problem, you will see this emphasis on matter of going concern. Okay, so next, okay, let's start the class. Just now what I share is about the auditor's opinion. So next is more on we look at the business model itself, and we look at the financial footnotes. So the $1 million question to ask, are you investing in the companies with red flags? So if yes, is it a very bright red, or not that bright red, or slightly less? So if let's say it's a bright red, I think you may need to consider to cut loss, or close the position. Oh, but case by case, it really case by case on your investing journey, because every investing journey is different. Every company is also different. So you need to make the judgment yourself. Okay, these are the list of items I will cover today. So on the left hand side are management related. On the right hand side are the business and financial related. So management related. First is to check whether there is a significant share pledge. So some companies or some some insider, right? Some significant shareholders, they will put their shares as a collateral for their loans for personal use. So there's a risk of large share pledging. If let's say the companies or the insider make large uh, part of their share as a collaterals, uh, so the company has to maintain the value of collateral all the time, providing the additional share to lenders or to the bank if the share value erodes. Let's say the companies or the insiders fail to make up the difference whenever the collateral value or the share price drop in the value, the bank or the lenders can force sell the share in the open market to obtain funds. This will reduce the controlling rights in the company and lead to further market declines. So what you need to do here, search for the keywords in the annual report: pledge, share pledge, loans and borrowings. So look and look in details what has been stated there. This is my criteria. It's not a hard and fast rule. If let's say more than 10% of the company issue shares are pledged as a collateral, then I will be very worried in this company. What if the company suddenly share price drop in value? Then if the bank will force sell the shares to collect back the fund, and then it will lead to another further decline. So as much as possible, try to minimize this risk or not to invest in those companies. Use shares to secure loans to meet personal needs and fund other ventures or acquisition outside core competency. So this is more applicable for business. Some listed company, they use their own shares as a collateral and borrow money, and then they invest in something else, not related to their core operations. So this is very dangerous because why they want to invest in outside their core competency? Question to ask. Are they going to siphon the money out? We don't know, huh? Okay, for Singapore listed company, actually there's a rule protecting us as in Singapore, rule 728. Any share pledge activities arrangement, they must immediately announce it to the exchange or Singapore exchange and make it public to shareholders. So search for the keywords loans and borrowings in the annual report and check for any share pledge activities. For Hong Kong listed company, you just need to search for the word pledge. It's very simple. Hong Kong is more straightforward. You just search for the word pledge, and then you look at those statements are being announced, and then you calculate, okay, how much they shares they borrow. You use the share total amount of share they use as a collateral and divided by total share outstanding. Is it a lot? If let's say it's a lot, let's say it's a more than 10%, then and be cautious. Oh, yeah. Okay, in US listed company, they have to report it in the proxy statement, DEF 14A. So and to make it public to shareholders. Okay, this is a Hong Kong listed company. As you can see here, this company is a property developer. Actually, their AFA are really very good. You can see here the EPS are rising, ROE 20% plus. Cash flow are also rising. NAV per share is also rising. Net asset value, debt to asset is very high, 60%. It's very high. More than my benchmark of 40%. Revenue rising, dividend also rising. So I would say this company, the AFA score is 7 out of 8. Wonderful company from AFA point of view. But the problem with this company is that in 2017, the company owners, Minwin Investment, which is owned by the founder. This company, they pledge it owns about 55% of the company, but 27 of the total shares is pledged as a collateral for a bank uh, to borrow money. Uh, so this is no, I'm not very comfortable to see this because it's more than my 10%. And some more, this company is a property developer, is in the cyclical industry, and is very dangerous. Whenever the market turn down, then you will see the share price go down, and then the company has to top up their collaterals. If not, the bank will force sell their shares. So, and in 2019, 2 years later, the company share price plunged 89% on one day. So lost about 1 billion uh, in value. As you can see here. So cyclical industry plus large share pledging by insiders is a recipe for disaster. First of all, we want to avoid cyclical industry. Yeah. If it is a cyclical industry, make sure the company is in the structural uptrend. For example, semiconductor industry is a cyclical industry, but it's in the structural uptrend, then that should be okay. But you have to read case by case. But property development, I would say, is a cyclical industry, but it's a structural downtrend in China. So that's why it's not a good sign. And also, this company has a high debt ratio, borrow too much money, and and they have a large share pledging. So drop in 90, not drop by 90% in one day is very scary. Okay, this is a listed companies in Singapore. So as so you just go to the loan and borrowings, and then you can see here, they have the directors of companies uh, uh, make a loan, uh, borrow money from the bank by uh, on their shares as a collateral. As you can see here, percentage of shares pledged is about 55%. This is even higher. So that's why the company share price keep going down, and some more they're in the cyclical industry. So high amount of share pledging by insiders is usually a high risk. Okay, listed company in US, Tesla, needs no introduction. You can see here Elon Musk. You look at the profit statement, uh, and this is 2023 lah. I'm not sure what would be the latest numbers. And you can see here, Elon Musk owned about 20% of the shares of the company at that time. And then there are about 200 million shares are pledged as a collaterals for personal use. So if you use this number divided by the total number of shares they have in Tesla, it's about 7.5%. So not yet meeting the 10%, but something to watch very closely. Yeah, some more Tesla is in, I would say, is in a cyclical industry, very competitive um, market. Auto market is a very competitive market. And let's say this amount going higher, and then Tesla performance is not going to be it's not going to do good. Then that will be double whammy for the company share price. So in summary, check if large part of the issue shares are pledged as a collaterals, and check what are the regions of the share being pledged. Okay, that is number one. Number two, check if there are related party transactions. So a company derives a significant portion of revenue or lends significant amount of money from or to affiliated entities of subsidiaries. So you can see here, the insider or the management company they own they own shares of the listed company, but at the same time, the insider or the management also that has interest in other company. And this other company X sell goods or buy goods from the listed company, or even they lend money from the listed company. So in the way that this is prone to some kind of accounting manipulation, some revenue fabrication. So let's say company want to make let's say the insider want to make the listed company looks good financially, they can just make a fake buy order from the listed company, buy a lot of goods, but actually there's no good deliver lah, or maybe there's a good delivers, but they jack up the price. So you want to make sure this activity, this related party transaction is as small as possible. Yeah. And another is a parent company. They own the listed company. Listed company also sell goods or services or lend money to parent company. Listed company own the subsidiaries, and then listed company also sell good or lend money to subsidiaries. Okay, actually there's nothing wrong to do related party transaction. There's nothing wrong. But just should make sure the least amount is as small as possible. Yeah. For example, okay, let's say for example, some company uh this happens quite frequently, is that the listed company, the founder owns the listed company for sure, and then they also own the shares, and the founder also own a building or another building. This building will lease to the listed company, and then this company earn some rental fee lah, leasing fee. But the building is not owned by listed company. It's quite common, but you have to make sure this amount is as small as possible. Okay, so what are the red flags? Red flag is if let's say the related party revenue or related party sales is more than the 10% of the sales revenue of the company, or if the listed company provide loans to or financing to related party, just be cautious, be aware. Okay, search for the key. What you can do is go to the annual report, search for these keywords: related party transaction, interested person transaction, amount due, related party, related parties. So search. What I will do, this one is not hard to do. Go to download the annual report, put in the search, put in the words in the search request, and then just search, and then until you get no more or everything clear. So just want to make sure you are clear of the risk for related party, a large related party transaction. Okay, this is a company listed in Hong Kong, Tong Ren Tang. It's a very old company, few hundred years. They are pharma retailer specialized in Chinese medicine. And yeah, they have two key products, Angkong Niu Wang, and this is Ling Zi, to enhance immunity. Yeah. And you can see here their equity structure is very complex. So you have the parent company, Torrent Tang Group, on 52% of the Shanghai listed company. And this Shanghai listed company on 47% of the Hong Kong listed company. And then this Hong Kong listed company on 38% of another Hong Kong listed company. And this Hong Kong listed company on worldwide subsidiaries, Tong Ren Tang. And then the parent companies keep selling the products from all the way down to the subsidiaries. You can see here. So, and you calculate, luckily for this company, the related party sales is only the 3.5% of their total sales. And then the related party purchases is only 8% of total sales. It's not huge, but it's something to be cautious of. Because luckily they are selling the same product. It could be the parent company manufacture the products, and then they just sell the product to the subsidiaries. And good that the related party sales is not huge. If let's say it's a more than 10%, it's something to worry about. Well, so So first you need to check if there is a large related party sales or transaction, and check if the listed company provide loans or financing to the related party. Okay, so for this one, you got to go to the annual report and check. Same thing, go to the search for the same keywords and look at those whether you have these loans or financing to the related party. I try to avoid this one because it's not clean. Why the insiders want to borrow money from the listed company? They can as well borrow from bank. Why they want to do this? So to me, I as much as possible I want to reduce the risk. And some more, some of the insiders they borrow at zero interest from the listed company. That is not fair, to the we as a shareholder of the company. Okay, so number three, check if there is a questionable ethics culture, poor employee culture, or poor corporate governance. Okay, red flag will be one of the red flag is track record of corruption involving several executives and managers in companies. So Mao-Tai, this is a good company, very good brand. They are a brand that can raise price year after year, but not recently. Recently they cut price. But this company has a problem with their management executive. You can see here, sentenced to life in prison for bribery, under investigation from some uh, general manager given death sentence. Uh, so a lot of problems. I always hear the problems with multi-management one. They always got this so it's not clean, even though the company business is good. If you ask me, I won't invest in this company lah, because there are so much more companies in the world to invest. Why would you like to why I would like to invest a company with some management problems? Okay, state-owned enterprise are pressured by the government to make business decisions which are not very accretive. Okay, China Mobile. China Mobile is a state-owned company in China. In 2010, this happens long time ago, 25 years ago. They are forced to acquire 20 stake in the bank. Uh, but bank is not their core competency. So there's no synergies between these two companies. So over time, you can see their return on capital keep dropping and dropping. But I'm not sure what happened. What is the return on capital recently? You can go and check. But there's always a risk with state-owned enterprise. They are forced to make some investment outside their competency, and they also uh, and also the management of the state-owned company are not as motive. I would say not all of them, not as motivated as private companies that are run by founders. So because founders, I prefer private companies because especially they are still run by the founders. Because founders, this is their babies. The listed company are baby. They create the company, they bring the company to listing, and they are long term oriented. So I prefer those businesses because usually those businesses are aligned with shareholder interests. But for state-owned enterprise, case you have to look at it case by case, and bear in mind there's always some risk of us with associated with the state-owned enterprise. Same goes to Singapore state-owned enterprise. So usually they put in the management which are not at the same competency as what is required in the business. In some cases, so management of listed company keep saying their company work culture is good, but the employee turnover rate is high, review is poor. Okay, so for this for the listed company in US or Europe, you can always go and check and the Glassdoor rating. So for example, company called Wipro, uh, this company I remember they always say their culture is good, but the Glassdoor rating is very poor. Culture is very bad. Fact is that a few independent directors resign at the same time. and there's a frequent turnover of CEO and CFO. So this company in data pulse, they will see that two directors are design, EGM also cancel. It's not a good sign. I feel like directors design at the same time also, especially CEO and CFO resign. Okay, for Hong Kong listed company, you can go to this web dash site to check whether the company are bad actors or in the bad actors, whether they are bad actors running the companies. Although the founder of the website has stopped maintaining the website, but the website is still there. It is still a good reference for us to check whether there are still bad actors in this company. Okay, so in summary, you check what are the manager's track record and past history. If a company is designations of independent directors. Okay, number 4, check if the management has consistent unfulfilled promises. Teledot is a company that is an example of a company that tend to overpromise but under-deliver. So as you can see here in 2022, in March 2022, the CFO of the company said, oh, in this year, we are able to grow the business in 25%, 30% range. And she also said that we have very high visibility into this growth rate, very high visibility, paint a very good picture. But you can see here in 1 month later, I mean 1 month later, March 22 and April 22, so they cut their guidance from 18% to 23%. So I would say, you say high visibility, then 1 month later you say you cut significant your growth guidance. So I would say Teledot is the management cannot be trusted in this manner. I would prefer company to be to under promise but over deliver. Sometimes it's okay to company to not to provide guidance, not to provide this kind of guidance because for example, Mercado Display do not provide guidance, management do not provide guidance. So it's okay. Warren Buffett, Berkshire Hathaway also do not provide guidance. So it's okay not to provide guidance, but as long as you have you have this integrity, you have this to you know what you know what you are doing, and then you deliver the result, then should be okay. Now not to provide guidance. The last one for the management is that check if the management consistently sell shares despite low share ownership. So we know that the management buys shares if they are confident of company future prospect. So we know those managers who make regular or small purchases like stock option. If want to pay very close attention if the stock purchase and the market is as significant for a manager, you compare to his or her net worth. So it's not easy to know the insider net worth. But if you can find this their net worth and you calculate the purchases, the insider purchases, that will be very helpful. And not all the managers are equal, and you just pay close attention to CEO, COO, and CFO. When these 3 executives are buying shares, it tells you something. Okay, so management. Okay, the problem is that management, they get the stock option, and then they sell them to private immediately after the stock option, and this can create dilution of existing shareholders. So as much as possible, we do not want to see this, or they earn the stock option, they sell it immediately. But I noticed that in US company, this is the company, most of the companies do that. Because they have very little salary, then most of their income are tied to the performance, tied to their stock option. So I will say the red flag will be if the manager own less than 1% of shares and consistently sell shares whenever they receive share compensation. Oh, this is what I will avoid. So AMC, a movie theater company in US, as you can see here, they you have a stock option granted on 31st of March, and then 1 week later, these officials sell their shares. And this you can see here the list of liquidators get the stock option, and then they sell the shares 1 to 2 weeks later. So not a good sign lah, to see this. And another example, in January, I can say every quarter you will see this. I'm not sure what happened to the directors and CEO and the officers receiving shares. 1 to 2 weeks later, they sell their shares. And some of the company management own than less than 1% of the companies. Not a good sign. So I would say you have to have this combo, management on the less than 1% of shares, and then they keep selling the shares of the company whenever they receive stock options. Not a good sign. Yeah, so management on less than 1% of the shares. So check what is the management ownership of the shares. Check if they are consistently sell share whenever they receive share compensation. Yep. So that is for the management related. So if you do this, I know there are a lot of things I can cover, but if you do this frequently, you can finish it very fast. You just search for the keywords I told you, and then you then you do a checklist. Hey, this one check, and then this one no, and then maybe you will say, okay, there's a risk related to this company. Okay, the next one will be business and financial related. So there are 7 of them. So let's look at this one by one. Financial red flags are usually overstatement of the following. Company is earning more than actually it is. They can do it by inflate revenue or deflate expenses. Asset, company has more net asset than actually it does. You can inflate the asset or deflate liabilities. So let's look at this. Income statement, this is a typical income statement. You have revenue minus expenses plus any one-time gains. For example, you have a real estate valuation gain, or you sell some equipment, you have gains, minor losses. Let's say you real estate drop in value, you have to account it in the income statement, or you made some losses in some investments, or you have to write off some losses. So there is a put in the income statement. So then you have earnings. In the balance sheet, you have asset plus liabilities plus. In asset equals liabilities plus equities. So under the asset you have a cash, account receivable, inventory, property, investment, and others. Then in liabilities, you have debt, account payable, others. In equity, you have stock, capital, return earnings, and others. So at the beginning of the year, you have the value of the balance sheet. At the end of the year, you also have another value, another figure for the balance sheet. So let's say you have any cash flow activity. Of course, that will involve the change. Of course, the others item also will change over the course of the year. Cash flow statement will be any 3 cash flow activities like operating cash flow, investing cash flow, and financing cash flow. And net you have a net cash flow. So the net cash flow, any positive net cash flow will add into the cash. Any negative net cash flow will minus from the cash balance. Okay, when the company increase revenue, this will increase in earnings usually, or all else being equal. So let's say in company increase in revenue, their net earnings also increase. If the company receive cash from the customer on the service sales, it increase the operating cash flow as reflected in the operating cash flow statement. So let's say when they made the sales from to the customer and they receive cash, then operating cash flow increase. So let's say the others remain equal, here you can see net cash flow increase. As a result, your cash flow and the net positive cash flow will also add into the balance sheet. Of course, you increase the in earnings, then the return earning also increase. So as you can see here, this is how the movement of the financial statement usually. Sales increase, earning increase, add into equity, cash flow increase, add into the cash value increase. So at the end of the day, the balance sheet will be equal. So what happens to aggressive revenue recognition? So we know that revenue is the top line of the income statement. We study the trends in the revenue growth to assess the company strength. Accurate revenue is important to the confidence in cash flow because in the income statement, the bottom line of income statement is the top line of cash flow statement. So any manipulation in the revenue can affect the whole financial statement, also affect the cash flow. So what are the factors affect the quality earnings? Let's say you have aggressive revenue recognition. You have aggressive inventory management. There's a large changes in the operating cash as expenses. There's some tax issue, and that will affect the net profit. So actually, the most critical concern will be the revenue because uh it it will affect the whole line, whole income statement. It will affect all the way to the cash flow statement. So revenue is this is just to illustrate, revenue is a key driver of the three financial statements. So you can see this income statement because the net profit, which is the bottom line of the income statement, is the top line of the cash flow statement. So let's say any changes in the revenue, any manipulation in the revenue, you can affect the bottom line. It will also affect the cash flow statement. And so revenue is a top line in income statement, is actually our bottom line for investors. So that's why we need to study how the company recognize the revenue. If the company recognizes the revenue in a different way, determine the pricing mechanism, then need to be cautious. So if usually in the same company, in the same industry, different companies will have a different kind of business model. For example, in software industry, some company will do software sales as a subscription. In others, they will do sales of the software as a product, one-time purchase. So different companies will have their different pricing mechanism, and you need to look at those. So as much as possible, we want to of course we prefer the sales revenue to be recurring in nature, and then we want to make sure there's no uh mm, fabricated sales behind. Later I will cover what do I mean by that. First of all, what you need to do, you go to the annual statement, you search for the revenue recognition, search for this keyword to understand how the company recognize the revenue. Are they doing product sales or are they service? Are they doing service sales, subscription sales? All of them you can find the information in the revenue recognition. So okay, there are three different ways of how a company can recognize the sales. The first one, the transaction based. The second one is percentage of completion. The last one is recurring. Transaction based usually earned from one-time customer payments. So meaning the company just make a transaction, pass the product to customer, they see the sales is made. So the question to ask is, what is the lifespan of this product? As an investor, we want to make sure the lifespan is as short as possible because the same customer, we hope that the same customer will keep coming back buying the product because the product has a short lifespan. For example, food and beverage is a transaction based, but once the product is consumed, it's done. So the customer will come back and buy the products again. We want to see the recurring nature of the transaction based business model. This is unlike company that sell big ticket item or machinery. They sell the machinery to the customer, and after a few years, we do not know whether the customer will come back to buy the product or it may be they only may not or they may want to they will purchase from other competitors. So we prefer to have short lifespan or consumables at events. So this will be example that these are food beverage companies. Percentage of completion business model, the company earns from their percentage of contract or project has been fulfilled. This usually happens in the project-based company that does projects with customer, like 2-year project or 5-year project, and then they recognize the revenue based on the percentage of completion. So property developers or any large projects, infrastructure project, or uh, usually company has this kind of business model. The last one will be recurring. This is what we prefer also. We earn from ongoing payment from continuing service or after sales service to the customer. It has a higher predictability. So Silverlake, this one is no longer listed in Singapore. So it's a software service company that offer after sales service, maintenance service for the banks. So Old Chunky, what you need to do is go to the annual report. You can search for the revenue recognized, how the revenue is recognized. So they say in this company that is done through sales of goods, through outlet sales and non-outlet sales. And whenever they sell the product, deliver the products, and then the sales is recorded. Of course, the company also earns interest income from their bank in the bank. But this is not their core business. The core business is selling the food products to the customer. It's a transaction based. And city development is a property developer. You can see a development property for sales, and revenue is recognized when the control over the development property has been transferred to the customer. And is recognized over time by the reference towards the completing the construction development property. So it's a percentage of completion. And the company also earns from hotel income. So it's recognized when the accommodation and rental service are rendered transaction based. So every company is different. And you just want to make sure the sales is as recurring as possible. Okay, then that is the sales part. Then we look at the cost part of the income statement. Company usually have two types of costs, fixed cost and variable cost. So fixed cost is always fixed regardless of numbers of products or units you produce. Variable cost will increase based on the numbers of units you produce. Okay, the fixed cost is a cost that does change. For example, rental lease payments, staff salary, insurance costs, property taxes, interest expenses, depreciation, and amortization. No matter how the economy is doing, let's say your sales volume is dropping a lot, you still need to pay these fixed costs. So we want to make sure this fixed cost is as small as possible, or as a percentage of the total cost. So red flag will be large percentage in fixed cost, and the company is in a cyclical or project-based or sustainable business model. This is a red flag. Another risk we can to highlight is that if let's say the customer is very concentrated, meaning one single customer account for 10% of revenue, or large five customer account for 30% of revenue. So such for the keywords, largest customer concentration. There's a disadvantage to this. Losing a customer can be devastating on the revenue and can destroy the business. And the customer has higher bargaining power. Red flag will be high customer concentration plus if the business is cyclical business model is project-based, unsustainable business model. Okay, let's look at an example of high flux. So this company no longer listed. So what happens at this company? They has two type of business. The first business, 70% of the sales help to construct the plant uh, and the water plant. The second business is a service revenue. They help to operate and maintain the plant, so on from 25%. So this is how the business model looks like. The first business is a percentage of completion. And it also is a project based, meaning after the project finish, then the revenue is not there. And they can only recognize uh, during the project is running. The second business is recurring, which is good. And you can see, first thing first, I look at this, 70% of the sales is based on project. I will avoid investing in this company. And then look at okay, this is just an illustration. 70% is uh, non-recurring, 25% is recurring. If is the company business model sustainable, let's examine we know that the revenue, only 25% of them is recurring. That is the amount of numbers that is recurring. And if you look at the cost structure, the fixed cost, staff cost, depreciation, amortization, impairment, other expenses, financing costs, these are fixed. No matter how economy is doing, no matter whether they get a project, they still need to pay this amount. So it's about 286 million now. So 87 million is recurring. Let's say the project is lost, they only can earn this figure, but they still need to pay this amount of fixed cost. So I would say their business model is not sustainable. So by doing this, by examining this, you will avoid this company. Okay, the other way how the company can aggressively recognize their sales is that is the early delivery of products, shipping before customer requested, shipping late, shipping unfinished product. So check if the revenue rec recognition policy is revised. So to do this, you need to read a few year annual report and you compare whether have they changed their terms and conditions with their customer. Starting the channel, inflating their sales and earning figures by deliberately sending retailers along their distribution channel. So need to ask, because some retailers, they need to ask who are the actual customer? Are they end user or are they distributors? And you need to watch for shipping product to an intermediary and consignee, direct and actual customer. So distributors sometimes it really depends on the some distributor of course is good because it help you to distribute that to the market. But let's say they are used in the wrong way, it can be bad for it can be easily manipulated. If let's say the distributor is owned by the insiders, then there is something to be cautious. Yeah. Usually what I see in some fraud company, right? Usually distributors are also owned by the insiders of the company. So the public company owned by insiders, and the insider also own the distributor, and then the public company is the company sell the goods to the distributors. So they can usually stuff the channel, you can usually inflate their sales easily. misclassification. So they put in unusual items, extraordinary items, non-recurring gains, interest gains as part of their continuous operation. So usually this should not be part of the operation, continuous operations. So check the revenue by segment, check the revenue recognition. But usually in normal case, these numbers are not huge as compared to the total sales. Yeah, but let's say this number is huge, then need to ask, are they are they why they make such a huge number, huge figures income from non-recurring gains? For example, they put their bank money in the bank or they put the money in the investment product, they gain the certain percentage interest income. We want to make sure this interest income is as small. If let's say this interest income is high as compared to their operation, then need to ask, are they doing their core business or are they simply lending money to the investor or investment fund? Okay, bill and hold arrangement. Company invoice the customer and recognize the transaction as a revenue, but the product are shipped until later. So just search for the word bill and hold and just be cautious. Incentive for customer. Recording revenue when the buyer's payments are remain uncertain and unnecessary, or the buyers lack the ability to pay and seller change the assessment customer ability to pay and induce sales by allowing exceptionally long time to pay. Okay, so some companies they want to make the sales figure better. They increase their credit terms to the customer. So for the past, for example, 90 days, they increase to 180 days. So just to incentivize the customer to buy now. So watch for seller provided financing, or you provide loan to the customer so they can buy more products from you. Watch for seller the offer extended flexible payment terms. Be worried when the new extended payments terms are disclosed and DSO rises. DSO stands for Day Sales Outstanding, which I will cover later. And just be cautious. Improper percentage of a completion revenue recognition. This happens to the project-based based of company, kind of company. They overestimate the percentage of work completed over a long-term contracts and accelerate revenue recognition. So recognize the revenue before completing the materials recognition obligation under the contract. And then you need to check whether they change the revenue recognition policy to record the revenue sooner. So you need to check a few annual reports to check their revenue recognition. Shifting the cost between projects and improperly referring the project cost. Changing estimate assumption used in the POC accounting. Be alert for upfront recognition and for the long-term license contracts. And check if the company has large deferred revenue in the balance sheets. If the company revenue recognition is revised, such that they can recognize the revenue earlier than expected. So just be careful. So a few things to unpack here. The first one is to check the annual report revenue recognition year after year. And then the other one is to check in their balance sheet whether they have a large deferred revenue. So this usually happens in the project based on kind of company or company offer contracts. Okay, related party transaction just now I cover. So they sell the product to related parties. Just want to make sure the numbers is as small as possible. Okay, if a sales is made on the credit terms, account receivable increase rather than cash because the customer has not paid yet. Oh. So, okay, let's go back to our financial statements. What happens to the financial statement? So when the sales is made, revenue increases, earnings also increases, or all else equals. But this time, because the customer has not paid you cash, they 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 put in the credit, then that will increase the account receivable. They said the company has yet to receive cash from the customer. Of course, the earnings will increase because you have made the shares, the earnings increase here. Equity also increases. Once the customer pays, account receivable will decline, cash balance will increase. So the others remain no change. So this is how the movement of the financial statements will look like if a sales is made on the credit terms and once a customer pay in cash. Okay, so we know that some customer will pay in credit, will put in the credit first and then will pay in cash later. Of course, as a business, we want the cash to be paid as soon as possible. There's this financial ratio, very helpful, very useful financial ratios called days sale outstanding. It measures the numbers of average of days the company takes to collect payments after the sales is made and illustrate how well a company account receivable are being managed. So it's given by this equation, account receivables divided by revenue multiplied by 365 days. What are the red flags? The red flags are rising days sales outstanding, meaning the account receivable increase faster than the revenue over the past 3 years. And then these numbers, days sales outstanding more than 180 days. You need to check why. Why the customer take more than 180 days to pay you in cash after the sales is provided. Usually, government kind of business, okay, sorry. Usually, if your customer are government, usually government pay you very slow. Or some government, they will pay you more than half a year later, they'll pay you in cash. That's why as much as possible, I would like my the stock I invest has less exposure to government as a customer because I do not know. Uh, Usually more than 180 days, customer has to find way to finance their operation because they have yet to receive cash from the customer. They have to raise cash, they find cash to finance the operation. So something to be cautious. So all in all, these two numbers are very, I would say, very red lah. If let's say 180 days is a no-no for me already. Okay, unusual increase in DSO. What will happen? What happens? What is uh what has contributed to unusual increase in DSO? Customer taking more time to pay their bills because due to drop in customer satisfaction. This is one of the reason. Or company is offering customer longer terms of payment to drive increased sales, or company is offering customer with poor credit to purchase on credit. And okay, so in this, you need to check the company credit terms. Or the company is shipping extra inventory to distribution channels and inflate the revenue and offer user terms of payment. So this is a channel staffing we have covered just now. More than 180 days, need to check who are the customers. Their financial breakdown, can they pay back you in cash? Need to check. That is the nature of industry, huh? So maybe you check, maybe in this industry it's like that. All the clients tend to the pay back you slower. For example, I noticed in the hospital management business, if your client is hospital, usually are owned by government, they tend to pay you slow, more than half a year. It happens in China. So a lot of Chinese hospital service company, management service company, they tend to get their cash slower. So it's a natural industry. But as much as possible, I want to make sure I do not overexpose to this kind of business now because we do not know one day uh the the business will have cash flow problem. Okay, how a loser payment can affect the future EPS and the share price. So this is just to tell you, a loser payment terms uh can can be dangerous in the future. So looser payment terms, account receivable increases, problem with collecting receivable from customer with poor credit, and then this, and then the company will make another looser terms again. This thing happen again now, the vicious cycle. And because some customer cannot receive the you cannot receive the cash from some customer due to their credit problems, then you have to write down their receiver as a bad debt. And because if you have a write down, then you have to write down to in the income statement, the profits will decrease. This will lead to future share price decline. So this is another company, no longer listed in Singapore. It made footwear and sport apparel in China. So how they recognize the revenue is that they sell products to customer. They manufacture product, they sell the product. It's a retailer business. And in terms of AFA, ROE is more than 10%, but this is a slowing down of ROE. EPS uptrend but slowing down. Cash flow is positive, turning up. Net to asset ratio is less than 5%. NAV rising, revenue rising, dividend in general is rising, but in 2010 there's a special dividend given. I would say the AFA is 7, at least 7 out of 8. But if you look at the DSO, days sales outstanding, since 29, since 2009, you can see the DSO increased tremendously, from 61 days to 195 days. Take a long time to receive cash from the outlets, distributor outlets. This is not a good sign and tremendous increase. So you always see two red flags. Consistent increase in DSO, and the DSO is more than 180 days. So let's examine the footnote of the company. 2010, the credit terms is about 90 to 120 days. It used to be 30 to 90 days on credit terms. Then they have revised it again in 2011 to 121 days to 150 days. And in 2012, it's also 121 and 150 days. So as you can see here, the company keep loosening their payment terms or credit terms to their customer. So this is not a good sign. So indication of company having problems to receive cash payment from their customer. So the good things about this company is that this company has no debt, ROE 14%, net profit 14%, revenue, sale, cash flow, profits are all uptrend. Company has a lot of cash, very little liabilities. Uh, the ironic thing about this company is that this company was awarded most transparent company by the SIAS, the SIAS. And also in terms of valuation, P is only 1 to 2, and the PB is 0.2. If you look at this, wow, it sounds like a very good investment thesis. Transparent company, very good financial numbers, very little debt, a lot of cash, valuation very cheap. So a lot of problem. This is a good, it's a build. You only see half side of the tree. But let's say you examine further, the other side is that DSO 195 days, which means the account receivable is over 50% of the revenue. And despite having so much cash, right, they still want to issue bond at 100 million yuan at 12%. And question to ask, why they want to issue bond as such, although they already have so much cash, why they will issue bond? And after 2 months they received this award, right? The company requested for suspension of trading after defaulting on the bond interest payment. And the CEO was suspended and the company defaulted. So I always tell my friends, always check the DSO, uh, account receivable, the day receivable, day sales outstanding, to make sure you are not uh eh, the investment, your investment is not at a very risky position, because you never know the company will have cash flow problem. No? Okay, so as a bonus material, if you purchase the course material, I will give you the list of company that has increasing days sale outstanding, or the updated list. Companies, these are companies listed in Singapore, Malaysia, Hong Kong, China, Australia, and US. So what you can do is that you can go and check whether your investment, the stock you have, are they part of the list? If they're part of this, maybe you need to be cautious. Are you need to check, you need to dig into further. Why the company can have such a high or increasing day sale outstanding. Uh, and you have to make your own judgment, whether you want to sell the company, or and most importantly, you want to make sure the risk is as low as compared to your portfolio. So in summary, for this part, we need to study the revenue recognition policy. We need to check if the fixed cost is makes a large percentage of sales, even, and also if the business model is cyclical or largely project-based. We need to check if there's a large customer concentration. We need to check if the account receivable grow faster than revenue by using this financial mesh ratio, days sales outstanding. Yeah, so uh, this will be the first part of the business financial related analysis. I think I have covered quite a lot over the past 1.5 hour. Maybe what you can do here, before I go next, we will take a 5 minute break, bio break, and then after the break, we will do some Q&A, and we will continue the class. So now the time is 10:23.
Yes,
We
and for whoever, if you need a copy of the notes, you can actually register. I give you the link here. Can WhatsApp to Dr. T lah. Yeah, once you get a copy of notes, you can actually receive all the bonuses. Oh, there are too many until I lost count. At the same time, you can have over 1 year of video recording to view. So you can refresh again. All right. So even for repeated students, all right, there are 50% new material. Yeah, so feel free to learn today. Huh? Yeah, if you have some financial constraint, you can also talk to Dr. T for help lah. Huh? Okay. All right, come back 10:28.
Thank you. Hello everyone. Okay, welcome back. Let me continue the class. So before that, let's go to the Q&A. Let me share my screen. Okay. I always have this Q&A session. I mean class exercise to 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 check our learning. To I mean, as a more, I may want to make it more interactive so that everyone can participate, and to reinforce the learning experience here. So over here, I have three questions. Each question will have four choices. So choose uh, the best answer. It may not the it may what do you call it? Some of the answers may not be accurate, but you choose the most suitable answer. Okay, I see the the first answer from Ting, recurring business model. Wow, you're very good. Okay, we prefer to invest in business with what business model? Uh, A, project-based, percentage of completion. B, transaction-based with high ticket items. C, regulated business. D, recurring business. Choose the the one that you think the best. Yes. Yeah, yes, most of you got it right. Yeah, thanks for answering. The answer is D, recurring based business. So this is our preferred investment now. Usually recurring based business will command slightly higher P ratio. But it's okay. It's okay to pay those P ratio higher. It looks high as on the absolute basis, but what we need to do, you compare the past 5 years or past 10 year average P ratio of the company. You want to buy into a P ratio that is lower than the 5 year average. Usually those company with recurring business model, I would think usually they will have 20 to 30 plus P ratio. But you pay for quality. You don't want to pay in the businesses, for example, uh, property developer that has only P of 5 or 4, very low PE, but you do not know whether in the future they can secure their sales in the future. Transaction based with high ticket items. Transaction based is okay, but we prefer the products to be consumable or shorter or has a lot shorter lifespan. High ticket items is not preferred because high ticket items is only needed. Uh, it depends on the customer capex cycle. If a customer willing to pay has a we can pay during good time. Company customer willing to pay to purchase more high ticket items. And in a bad time, they will defer the high ticket item purchase. Uh, Also, it happens in the auto or car industry. In the good time, people tend to change car. In the bad time, then people tend to defer their purchase. Regulated business model is okay to invest in the regulated business model, but you subject yourself to the regulation risk. So you need to watch the policy, uh, government policy from time to time. Usually regulated business model, you have advantage because your the licenses or approvals are limited in numbers. Uh, there are not many competitors in those industry, but it's not preferred lah because if you ask me, you want to have more upside potential, right? Then recurring based business and the recurring based plus growing business is are preferred. Okay, question number 2. If the company account receivables grow much faster than revenue, it is indicated by rising asset turnover, B, rising cash conversion cycle, CCC, rising day sales outstanding, DSO, or D, rising day inventory. Okay, yeah, so you guys got it right. The answer is C, rising day sales outstanding. Yes. Asset turnover compare the sales figure with the asset. Uh, uh, so it's not a, it does not tell you about account receivable. CCC is a okay. CCC is I not share in the class. They combine a few different metrics into one inventory. They also take fast the company can convert the cash, can get the cash. Yeah. They say they inventory, which I will cover later. Okay, the last question will be for investor, which one of the following is acceptable? 50% of the sales is from related party, CEO admitting mistake and being honest, unfulfilled promises and under-delivered, CEO selling share consistently after compensation. Okay, provided this CEO has very little share. Yeah. Yes, most of you got it right. Yeah, is okay, is CEO to admit mistake and being honest to us as a shareholder. Uh, we don't want to make the business so opaque, so that everyone, the shareholder, do not know what is going on behind. Yeah, yeah. CEO that admit mistake, Warren Buffett is one example. So who always admit mistake. Oh. Okay, let me go to the slide itself. Okay. Uh, okay, the next one is to check the company gross margin and days inventory trend. Okay. Okay, gross margin is also my preferred financial ratios because it measures the ability to control costs and also it measures the ability to pass along the price increases through sales to the customers. It's a tool to explain the competitive strength of the company. It's given by this equation, gross profit divided by the revenue, and gross profit is given by revenue minus cost of revenue or revenue minus cost of goods sold. So they are the same, huh? Cost of revenue and cost of goods sold, they are the same. One is more on the service base, the other one is more on product base. Okay. So we prefer this number to be to be stable or rising. Uh, so they to be above 40% because it tells me something about this company. Well, 40% is not easy. It's not easy to hit to reach 40% gross margin. But if let's say it can reach 40%, it tells me the competitive strength in that industry. Increasing gross margin could mean the company is getting more efficient in production or it has favorable pricing power. It can raise price while maintaining the cost. Decreasing gross margin could mean it getting less efficient in production or has no pricing power. So cost of sales increase, but the company cannot fully pass the cost increase to the customer, and or the company cannot raise price to the customer. So what happens is that the cost of sales increase, and if the company cannot raise price, then gross profit will decline. Then as a result, gross margin will decline. So over the past 3 years, decreasing gross margin over the past 3 years. The second thing is that if the company is in a competitive market and the company still need to cut price to gain market share, this is a red flag. Okay, SimPost. Over the past 10 years, over the past 15 years, as you can see here, the gross margin has been declining. Yeah, used to have a very gross margin, 40 plus, because you have a lot of competitive pressure. And simple this because people tend to exchange information over email. Then you have a lot of third party uh, logistics service provider. Then this lead to their decline in SimPost. Yeah, so a lot these are due to the industry factors. Yeah, as you can see the gross margin decline. Okay, so company use cash to make the inventory, and then inventories product eventually go into the sales. So the risk is, let's say, the longer the inventory ages, the greater the possibility the company is misallocating their cash and misjudging market. So we don't want to have this over bloated inventory base in the company. So there's one financial measures to measure this. It's called days inventory or day sales of inventory, DSI. It measures numbers of days that the company takes to turn their inventories, including goods and they are good in progress, into sales. It measures the effectiveness of inventory management of the company. So this financial ratio is only applicable for business that sell products or sell goods. So yeah, it's given by this equation: inventory divided by cost of goods sold multiplied by 365 days. We need to be cautious if the DI is rising over the past 3 years. Okay, there's no fixed number on whether is it okay to have inventories that last more than 180 days. It really depends on industry. Some industry, their inventories, for example, property developer, they they can have their inventories a few years one. So they build the buildings is not cannot be sold immediately in half a year. That's why on average the inventory is strong. It really depends on the industry. So you want to check industry by industry. What is the common days inventories? Oh, okay, what contributed to unusual increase in DI? Company is struggling with obsolete high volume inventory, or the company is misjudging the market demand, overstocking, which could be a problem with the products or as a result of too little marketing. Company that overstates inventory or understates COGS to boost profits. So I would say this is happening in the solar panel company. A lot because last time you have Biden incentive and you also have subsidy from Chinese government. A lot of solar panel companies build out a lot of inventories on solar panels. So they thought the demand is going to hit to the roof, but in the end, the demand is not that high. Uh, so there's a unusual increase in the inventories. Same goes to the car maker companies. Uh, in the COVID times, they taught people a lot. People got uh, paycheck, free money from the government. So they buy a lot of cars. There's an unusual spike in the demand for cars in US. Then a lot of US car makers, not just US car makers, a lot of car makers globally, they make a lot of cars to meet this demand, but now are suffering from the overstocking. So when the pricing of products is related to commodity prices, then company needs to perform impairment tests for foreign commodity price, and they may be required to increase reserve and write down inventories. Yeah, so this happens to let's say your products are related to commodities, then every year you have to do this impairment test, and you usually company will have to allocate some reserve for this right now. So just need to bear in mind. So whenever to do this, the increase of this right now inventory reserve, they will eat into their income statement. Yeah, if DI is rising, compare the trend with industry peers. How misjudging market demand can affect future EPS and share price. So we have a misjudging market demand, overspend in creating the inventories, inventory increases, inventory grow faster than in revenue, then problem with selling the inventory become obsolete, then you have problem to sell the inventory, then you have to write down the inventory because cannot be sold, then leads to future profitability, have to write down as a losses, then leads to future share price decline. So always check the day's inventory before that, so you will avoid these things happen. Huh? Okay, this company, Gearing Holdings, is in the oil and gas industry. So you can see that this inventory kept increasing from 2015 to 2016 for over the course of 2 years. So these are quarterly numbers. And then because they cannot sell the product fast enough, that's why they have their inventories increase. Then in 2018, they decided to write down 30% of their inventory, and this caused a net loss in income statement. So when you do this, you will avoid this. This inventory, days sales outstanding is a what do you call it, is a leading indicator before any write down in the future. So always check these two uh, to to reduce your risk. Okay, so if you have a you have a cost material today, you also get a list of company with increasing days inventory. So this is a company for Singapore, Malaysia, Hong Kong, China, Australia, and US. You will get the list. Okay, so in summary, always check the gross margin trend, check the days inventory, my financial metric, check the historical rate trend. Okay, the next one will be we would like to check if there is an aggressive profit management. Some companies shows unusually high profit margin as compared to their industry peers. Check whether this is due to aggressive accounting treatment. So the company tend to reduce their expenses. They reduce losses, that's why they lead to increase in earnings. Uh, what other expenses can be reduced? R&D expenses, depreciation and amortization, SG&A, selling and general and admin expenses. Losses, asset write-down, impairment of goodwill, loss on sales of investment, loss on sales of asset. Yeah, usually these numbers, some management tend to manipulate. For example, the goodwill has to be impaired. They don't want to impair the goodwill. They have to write down some asset, but they do not write down the asset, or and and the asset is making losses or investment is making losses, but they do not want to sell the asset or investment. Or the company want to this is not manipulation, this company want to reduce the R&D expenses. They want to lengthen the depreciation and amortization period so that the expenses looks lower. Or company want to cut costs, cut their selling general admin expenses in order to boost their earnings. So these are the few ways that company can improve their earnings. So okay, let's examine some of them. Longer appreciation and amortization period. So company can make longer depreciation and amortization period than the than the industry peers. Beware of the changes that do not make sense. For example, technology product that should not be amortized for a few decades. So compare that with industry peers and check for this is more on the asset heavy company. Check the capex to depreciation trends over a long term, which could mean depreciation expense is understated. Okay, capex to depreciation ratio, capex over the depreciation. Okay, these numbers sometimes I will check when when the company has asset heavy, has a high capex numbers. So you got to check if the capex capital expenditure is more than 10% of their sales, then that company should be a high intensity, high asset, a capital intensive company. So you just need to check this ratio. So the red flag will be this number is rising. So meaning their depreciation, they tend to decrease it as slower than the capex. Just be aware. Or the company has a longer depreciation amortization period than industry peers. Usually, I would say this is not a bright red flag to the company. It will tend to boost the earnings, but it won't cause you much problems as compared to just now the days sales outstanding, days inventories. Because I think some companies they want to show good profits. One of the way is for them is to do this, but it's not detrimental to their business itself, but just to be aware. Expenses defer to the future years. Okay, due to improper capitalization expenses such that R&D expenses, marketing expenses being deferred to the future years, amortized into the income statement as expense in the future. So check if the deferred expenses increase fast relative to their asset growth. So large deferred expenses as compared to the total asset, or large deferred expenses as compared to total intangible asset. Okay, anything more than 10% is a worrisome. Oh. Failing to write off the worthless asset. So there are some impaired assets such as uncollectible account receivable, worthless investment, impaired plant asset, obsolete inventory is not written off as a losses. So always check the DSO, DI trend, watch for decline in the allowance for doubtful account. So a rise in the account receivable and sharp decline in allowance is a warning sign of a company failing to record enough bad debt expenses and overstating earnings. So please check this also to make sure you don't get into trouble in the future. Failing to record expense for the current transaction. Watch for unusually high large vendor credits. Vendor credits are those amount the credit supplier owes to the company, given to the company in the form of credit. So and also watch if there's a large related party transaction. Be aware if the company fail to accrue expenses for loss consistency. So, for example, expected payments related to litigation, review of the balance sheet, purchase commitments. So, what are the red flags? Significant vendors credit given. You give a significant vendor credit so that the supplier can still owe you the money. So, just be aware, this is not a good sign. Large related party transaction, which just now we have covered, significant contingent liabilities. So what you need to do, you go to the annual report, you search for the keyword contingents or contingent liabilities. Then you will see what are those. Usually companies won't have this, but if let's say there is a contingent liabilities, and make sure this number is as small as possible. So you could be like company is in the litigation with other companies, then yeah, just need to be aware. Usually pharmaceutical companies will have this one. It's quite common for them to have litigation. Yeah. So is for me, I tend to avoid pharmaceutical company, the drug maker, because it's very first of all, they usually have litigation. Second of all, they the patent tend to expire in 20 years. So it's very hard. And some more now these days you have a unfavorable US policy to pharmaceutical companies. Review of the balance sheet purchase commitment. Just check whether they have to make some purchase in the future. Just search for the keyword commitment or guarantees. So some company, if let's say they want to expand further, they have to purchase some plants or they have to build buildings, they have to allocate some fund to build buildings for business expenses, then that is okay. If let's say they have to make some significant commitments on other purchase which is not related to their core business, then just be cautious or be worried about that. regularly turn the sales of business asset into a recurring activities. This is no good. Why they want to keep selling their business uh, to earn the sales. Yeah. Uh, watch for any changes in the revenue recognition policy. This is not a common one, but just be cautious. Misclassification. To make the profit look better, a company shift the operating expenses to the non-operating section, shift the non-operating items to operating section. Yeah. The good stuff shift to operating section, the bad stuff shift to non-operating section. Watch for the companies constantly record restructuring change charges. Watch for the companies that shift losses to discontinue operation. Yeah. And watch for the company to include investment income as a revenue. Okay, so the idea here is that they want to make the good because they know that investors do not look only at the income, but also look at operating profit or EBIT. Um, um, so they see if and if the operating income is good, that means the investment is good. So some company management they want to shift the bad items back away from the below the operating income line, and shift the good thing from under the operating income line to above the operating income line, so that the good stuff move to the to show to customer to investor, the bad stuff to show to uh to move lower so the investor will not pay attention. Yeah. But usually I look at this, uh this is a small, to me it is a small issue. Uh because as an investor we just don't look at 1 year ma. We look at multi-years. Can they do it in multi-years or not? Usually company will not do this in multi-years period. And also we also look at their operating cash flow, because accounting profit is the opinion of accountant, but cash flow is very hard to be manipulated. So we look at the cash flow over the past 5 or 10 years, then it tells us whether the company is really thriving. Usually, if the company record negative cash flow but positive profit because of due to some accounting treatment, it's not a good sign because flow is negative. So cash flow, looking at cash flow will help us to to what do you call it? To overcome all these issues. Oh. So what are the red flags? Changes in the revenue recognition policies that does not make sense, and consistent one-time items to boost profit. Okay, if the earnings grow more than the cash flow grow over the period, that could be a misuse of revenue recognition. Just like I mentioned, earnings are result of accrual accounting, cash flow is real. Earnings are of high quality when it reflects the cash flow, operating cash flow. That's why we look at the quality of earnings equation, operating cash flow divided by net profit. If this ratio is more than 100%, is high quality earnings. If let's say it's less than 50%, is a low quality of earnings. What the red flags is, company can make profits, but with negative operating cash flow over the past 3 years. This is a no for me. It's a no for me already. If the company has a negative operating cash flow over the past 3 years with positive profits, I will avoid at all. Okay. Some of you may be interested, what is the relation between operating cash flow and net income? So we know that net income is the bottom line of the income statement. So when it goes to the cash flow statement, you have to add all the cash movement. So for example, this is the non-cash expenses that they part into the income statement. You have to be taken into account, and any increase in the working capital also will change the cash movement. Okay. In the income statement, we have the depreciation and amortization, we have a stock-based compensation, we have the unrealized gain and losses. All these are not cash items, are not real cash expenses. And because they are not real cash expenses, you have to add back into a net income to find what will be the actual cash that company receive. And but also you have to take into account what are the cash movement within the business operation. Let's say the company spend on inventory, it reduce the cash. The company account receivable go up, meaning the customer has yet to pay the cash. That will give you the reduction of cash. If account payables goes up, because uh the company delay cash payment to supplier, that will lead to an increase of cash balance. So all these three items will change the working capitals, and as a net income plus non-cash expenses minus. And okay, why I show this slide? Okay, why do I show this slide, right? Because previously I showed this slide quality of earnings, and then some of you are interested why the company quality earnings going up, going down, why the company quality earnings is poor. To do this, you got to go to their cash flow statement to understand what are the source of low quality earnings or a decline in the quality earnings. If the quality of earnings goes down, could it mean the companies build out their inventory? I need to ask why. If the quality of earnings goes down, could it mean the company increase their account receivable? I need to ask why. So going deeper into this equation, you will know what is really going on the company quality or earnings. Yeah. Uh, this is just for you to make sense of the numbers, to understand the logic behind uh, the, the cash flow and the earnings relation. Okay, this is just now we have this Red Lifestyle, the footwear company. As you can see here, the quality of earnings is really very low. So our benchmark is 50%. You can see here in some year the quality of earnings like 15%, 6%, 2%, 10%. More than 4 years, quality of earnings is below 50%. So I will avoid at all costs. So because 50% is my benchmark. So by doing this, you tend to know there's a sign of problem ahead already, huh? Okay, high flux. High flux quality of earnings is, you can see here, negative. Consistently, they make profits. You can see the company can still make profit, but the operating cash flow is consistently negative. So this tells me the accountant is very smart. They still can make profit, still can make the income statement looks good from profit point of view, but despite having negative cash flow, it's not an easy task. But it is what it is. When you as an investor, you know this how to look at this, you will tend to avoid at all costs. Okay, let me take a look at your question here. Question from Ong. Does your assessment take into consideration of management options, self-sharing due to high capital gain tax imposed in those countries? Okay, you are talking about the assessment of the whether company has a red flag. Uh, no. Okay. High capital gain tax imposed locally is two independent items. Uh, if the company want to share their shares, uh, it's okay because company want to share their share. Maybe they want to earn income, from themselves. But I will be worried if the company management consistently selling shares and having low share ownership. I will be quite worried because it does not align with my interest in as a shareholder in that company. If the company management has very high share ownership, let's say more than 4 or 5%, and if their share to earn income, I think it's okay. It does not matter whether there's a high capital gain tax or low capital gain tax in those countries. It does not matter. Yeah, so that is my assessment of company management selling shares, selling stock option. You are talking about selling equity shares or to raise fund. for the company. Okay, if company is selling shares, equity, selling shares to expand businesses, that is acceptable because company want to raise fund, then to expand business for the future revenue growth, I think it's okay. If the company sell shares to pay back debt, to pay dividend, I will be worried. It's a misuse of the uh, equity raising for shareholders. So it depends on the case by case. Okay, so if you have a course material today, you will have the list of the company with quality of earnings issue or cash flow issue. So this will be given for those companies listed in these exchanges. So in summary, check if the depreciation amortization period is longer than industry peers, or if there is a consistent rising capex to depreciation ratio. Check there are defer expenses listed as a asset on the balance sheet. Check if there are significant vendor credits, large related party transaction, uh, significant contingent liabilities, or significant guarantees or commitment. Check there are any changes in the revenue recognition policy. This is very important. Always check the revenue recognition policy. Check if there's a constant one-time item to boost profitability. Check the quality of earnings. Yeah, so there are a few things to unpack here to check for whether the company has aggressively managed their profits. Okay, the next one is to check whether there's any deterioration in economy mode. Okay, this is more on the business mode itself. It's more on qualitative analysis. We know that economy mode are the structural competitive advantage that helps insulate a company from competitions. So this is a company profitability. So there are always competitors want to come in take the company profitability. So economy mode is a profit protection to help the company to insulate as an insulation. So what are those economy mode? It can be intangible asset, it can be a switching cost, it can be a cost advantage, it can be a network effect, it can be efficient skill. So all these I have covered in BA1 previously. So intangible asset could be company has a very strong branding, they work in the regulated environment, or the company has a proprietary know-how, and or they have a licenses, or they have a IP protection, which can help them to help them to earn that kind of high profitability uh, for themselves. Switching costs will be company products is locking into the customer system, and it's very hard for the customer to switch to other suppliers or other vendors. Even though there's a company want to increase the price to the customer, but the customer feel that it take a lot of hassle to switch to other vendor, then there's a high switching cost. Cost advantage would be that the company has a low cost advantage due to their economies of scale, or their production location is near to the cheapest location, or they have some access to critical raw materials. So they can keep their cost low. Efficient scale meaning the company is operating in a very small market. They are the giant close to the monopoly in that market. There's no incentive for other competitors to enter into that small market, and the existing player will continue to earn high profit from that market. Network effect will comes when the value of the product increases as the numbers of user increases. Like for example, Facebook, when more and more people using Facebook, Instagram, WhatsApp, the value of a WhatsApp, Instagram, Facebook increases. And then the company can earn from that network. Or whether the company can monetize the network, then they can earn. Okay, so our worry, because our course today is red flag in businesses, we want to check if this mode is narrowing or decreasing, deteriorating, and the long-term investment thesis will be compromised. So intangible asset brand, it relates to one willingness to pay more for a certain product or low search cost. What would be the red flag? If the company reduce the price of their product or services aggressively in order to get market share, despite it being in a high competitive market. So this is a red flag for me. Cut price to earn market share despite being in a high competitive market. Patents. Patents offer legal monopoly that's about subject to expiration, challenges, or piracy. What are the red flag? The company patents which give the most economic value are being challenged. And this happens in that the company does not have portfolio of patents. They only have one or two patents for their sales generation. And that patents face some substitute from competitors, then that is a red flag. Intangible asset in terms of government license, we know that licenses approval are limited in numbers, which can create barrier to entry, like for example, casino business. But what are the red flag? Governments take away the licenses or implement any policies that could impact on the company's sales, or the company or government allow many people to enter the businesses or industry, or allow more licenses. So that could be a red flag, or allow competition. Switching costs, the cost to switch to other supplier is high. It requires a lot of efforts, time, psychological toll, despite the money. So what will red flag? The quality of the product service you give to customer greatly deteriorates, and it affect the customer experience, which causes the customer to switch to alternative. So to do this, you need to stand in the foot of a customer to understand if the product is useful or not. Yeah, it degrades my experience. Then only then you will know, uh, and also when you know, and then you know, there's other better product from other competitors, and then it does not take a lot of time and effort to switch to that product. Then you know the company is losing their economy mode. Network effect, as more people use the product services, the very product or services increases for both new and existing users. What are the red flags? Company fail to monetize despite having large or growing user base. Yeah, so company must know the way to monetize. So for example, you know the difference between Snapchat and Instagram. Instagram knows the way to monetize their user base, but Snapchat still struggling to monetize their user base. So that's a difference. So if you fail to monetize, despite you having a large user base, it's a red flag. Low cost advantage. Your company can produce a product or services at much lower cost than competitors due to your manufacturing know-how, your distribution process, your location, your economy of scale. What are the red flags? Competitors manage to replicate your process, produce at a much cheaper cost, or has a better distribution channel, or there are many better substitutes that could impact the company's sales. So that could be detrimental how company with this economy mode. Efficient scale. Company operate in a small market. They only support one of a few players if it's much bigger than other competitors in that market. What are the red flag? New player enters the market despite being small and making losses. They don't mind to make losses. And this event could affect a profitability of all the incumbent players. So for example, in Singapore, since we allowed more telco operators to enter, in the past we used to have three telco, now we have a lot more. Then because of these new entrants, then the profitability will reduce because they are fighting for market shares. Despite Singapore is such a small market. Okay, so that is the science of economy literations. Yeah, so we always need to check lah. So to do this, you need to read the news, follow up the companies, check their competitors, understand their customer. Then you will know. Also check the industry landscape in order to know whether there's a deterioration in the economy mode of the companies. Yeah, so the next one will be checking the balance sheet item. Okay, balance sheet or the statement of financial positions is a snapshot taken at point in time of all the assets company owns and all the claims against those assets. Snapshot taken point in time meanings every point in time, every end of quarter, or every end of half a year, every end of a year, the financial position of company will be different. The balance sheet will change because of a movement of cash, for example, movement of receivable, movement of uh, financials, uh, asset and liabilities. So in the balance sheets, we have assets, liabilities, and equity. Asset is anything tangible and non-tangible owned by company to produce a positive economic value. Liabilities are the financial debt or obligation that arise during the course of the business operation. Equity is given by total asset minus the total liabilities. So we would like the company asset structure not to be very different from industry peers. If it's very different, need to ask why. Why they can have very different asset structure. Or it could be something or some accounting manipulation happening in that company. So this is a list of the items in both asset, liabilities, and equities. Uh, so a breakdown of company asset will give us an important source of information on their business operation. So these are the list of balance sheet items. So the first one, the cash and cash equivalent. So what does it mean if made a large percentage of total asset? That means the company is cash rich, is less risky, but it could be a sign the company is already matured or prompt the declining. So need to be watchful. If let's say it's a young company, just IPO, then it has a lot of cash, then should be okay. So to gauge the maturity of company, you check the sales growth rate. And if the company has so much cash, if the company still need to issue bonds at high coupon rate, then need to be cautious. You need to raise your antenna. Okay, why? Why this company doing this? This could be a red flag. And check if the large amount of cash is used to invest in unquoted funds or security. Okay, this may not be a red flag, it could be a yellow flag, but I need to check why they would need to invest in unquoted fund and security. I prefer the company has spare cash, they just buy T-bills, government bonds, simple product, or company or products that is listed in exchanges, not in some unquoted funds of security. You do not know. Maybe the fund of that company is owned by the insider. They try to siphon the cash out of the company. They will never know. Make sure this amount of large cash is small. So company has to make a disclosure in the annual report whether they have invested their cash in the unquoted funds. So the keyword you can look for is unquoted or unlisted in the annual report, and you will you find those information now. Accounts receivable. Uh, Company may not be so efficient in collecting cash from the customer on the credit use. If let's say account receivable is a large percentage of total asset, check the DSO and DSO number. Okay. Next, what if inventories is a large part of percentage of the total asset? Then that means the company could have a problem selling their goods or product to customer. Check the days inventory trend. PPE, property plant equipment. What if the PPE is a large percentage as compared to the total asset? Then you need to check whether the company has a high depreciation expenses and check whether the company changed their depreciation method and can affect their earnings. So check if the company has much different depreciation period as compared to their industry peers. If this trend is, if a capex to depreciation ratio keep going up, then there could be red flag. The company may be uh, lengthening their depreciation, the period. So just to be aware of. But for me, I tend to invest in company with uh asset light. I tend to be asset light. Spend less on the asset but capex unless the company is large monopoly, close to the monopoly kind of business. So for example, TSMC, they spend heavily in capex to build their fabrication plant. So I'm not too worried because there's so much money to spend. I don't think even the so much money they spend such that the competitors cannot meet the amount of capex the the TSMC made. So this is why TSMC can maintain their monopoly-like status in the high-end semiconductor chip fabrication. So it depends case by case. If the company has a high capex, I want to make sure the company is a large company, because that will give that will give this company a lot advantage over their competitors. Investment. What if an investment makes a high percentage of total asset? So need to know the motive behind that investment and the type of investment company has. If this the investment is unquoted distributed fund with frequent allowance or impairment, that is a red flag already because companies siphon their cash out of the balance from investor, invest in unquoted fund, and then every year you have a impairment, you make losses from those investment. So does it mean the management try to siphon the capital out from the investor? So something to ask. Check if the investment related is related commodity. Beware of the commodity cycle. So I'm tend to avoid this kind of commodity trading firm. Because commodity price are volatile. So every year their balance sheet will look very different. So this year the balance sheet you have this investment or the trading contracts related to this certain commodity, but next year the value change, the balance sheet item will also change. So be aware, Intangible asset. If an intangible asset is a large percentage of total asset, check whether it is due to a goodwill. A goodwill is subject to impairment in the future when things go wrong and can have a desirable can then desirable lower the future earnings. And check if this goodwill to asset ratio is significantly growing. If yes, check if the return on equity or return on capital is decreasing at the same time. So this will means if the company spend a lot of money, goodwill is something like let's say I acquire other company and I acquire it at above market price, then the value difference will be recorded as a goodwill. But I will be worried if the company make a large investment, make a large goodwill above the market price, and this investment does not guarantee and does not give the promised return to the to us as a investor, as a into the listed company, then it's just a matter of time. This company need to impair this goodwill. Okay. Later, I will have a case study to illustrate this one, the goodwill to asset ratio. Okay, over dependence on acquisition. And let's say the core business is not growing, they will make acquisition aggressively to achieve growth, boost profitability. But because you make acquisition aggressively, this will result in a goodwill. Uh, and goodwill may be impaired in the future if the acquired business deteriorates, then that will reduce the future profitability. So goodwills and intangibles are subject to impairment tests, just like inventories. If the acquisition prove disastrous, management usually write them down. Check if this goodwill as large as a percentage of total asset. If yes, the asset are overvalued due to the acquisition. What are the red flags? Red flag is significant and growing goodwill over the past 3 years, plus return on equity or return on capital decreasing, meaning the return on equity decreasing return on equity or decreasing return on capital means the return uh, the investment return from those acquisition is not so promising as expected. So it was then management maybe in the future will have to write down those goodwill or have to write down those investment. Okay, Simple's in this case study is a classic case study on the excessive goodwill. So if you look at the Simple's prior to 2016, the ROE is more than 10%, but you could look at ROE is decreasing. It's not a good sign already. EPS bumpy. Green line is going nowhere. Free cash flow going down, operating cash flow going down. Net to asset is less than 20%. NAV the uptrend, revenue uptrend. Okay, dividend, there's a sudden spike in dividend, but before 2016 is a stable dividend payer. So I would say 4 or 5 out of AFA. But if you look at the price chart, this company in 2016, seems like, you draw the support line here, it hit the support line. Is it a good buy or not? And then you see, the AFA okay, but it's not as good, but it's not as bad. Then you think this company is a monopoly in the Singapore, and you may enter into this company. But you haven't checked the goodwill. You need to check the goodwill. You can see here, goodwill has significantly increased as total number of assets that Simple has been acquiring as other businesses. And at one point in 2016, the goodwill hit about 20% of their asset. Yeah, which is a to me is a red flag, more than 10%. Uh, and also if you look at the uh opening cash flow return on equity X goodwill, it has been going down. Just now maybe you don't need to do this. You just look at the ROE just now. It has been declining. It tells you something really. Our goodwill increases, ROE decreasing. The 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 prom the return is no longer promising. So in 2017, the company decided to write down their investment, and this caused their profit to plunge by 90%. Hence, thus the share price tumble. So, increasing goodwill and decreasing ROE or decreasing ROC is a red flag to me. So on the other hand, a breakdown of company asset also give us an important source of information about their business operation. So this is more on the liability side. Loan receivable. What if the company is lending money and we want to make sure the loan receivable is more as compared to total asset? Okay, so need to check if whether this loan receivable to asset ratio is significant growing, and need to check whether is there any non-performing loans. Non-performing loans are those loans that cannot be corrected within 90 days. is significant. Okay, need to check whether these numbers are significantly increasing. Need to check whether company do any provision or write off of bad loans, and need to check whether there's a significant amount due to from related parties and subsidiary. It means the company is lending money to related parties or subsidiaries. I want to make sure this number is as small as possible. Prepaid expenses. These are the future expenses to be paid in advance. High prepayments can be assigned the company make payment to related parties for services that never happens. So need to check why lah. Need to check prepaid expenses over sales ratio, whether this number is growing. Okay, for me, I always put 10% as my benchmark lah. All these ratios, if this ratio is more than 10%, I will be very cautious. Okay, this company listed in Singapore Data Pulse. Uh, the company actually provide loans to two companies, which are mostly interest fee, and this loan is much larger than their revenue. As you can see here, revenue is 1.9 million, but if you look at the long-term receivables, 6 million, and long-term receivables are actually related to the shareholder loans related to two companies, and they are 15% interest and 5% interest. Okay, so it's 5%, but long-term, sorry, okay, they are mostly 15 and 5% interest, but there are some part of long-term receiver interest fee, which is 1.2 B, which is large. If you compare this 1.2 million as compared to the 1.9 million, it's quite significant. So I will tend to avoid. First of all, I look at the balance sheet. Long-term receivable as compared to total asset and compared to total sales is large, and I will tend to avoid already. So but this one you have to really check check in the footnote to really study this. So I put in the chart here so that easy to see. These are the orange bar are the sales revenue. The red bar are the loan receivable long term. As you can see here, the loan receivable is much longer, much bigger than the sales. So I'm very worried lah if the customer cannot pay back the loan or the related parties cannot pay back the loan. Okay, not to worry if you guys do not know how to find these numbers. Uh, in this, I actually created a list of company for you. If the company has growing loan receivable related to the asset and sales, and what you need to do, you just go to the list and check whether you have any stocks in those lists or not. Or if yes, maybe you need to check. You have to make your own judgment. Uh, you have to dig into deeper whether is it still worth your investment, and maybe the company uh, could have problem to receive the money back from from their either from the customer or related parties or whoever they lend the money to. So we will get the list of the companies listed in these exchanges. Okay. For liability side, you also have an account payable. What if the account payable makes large percentage of total asset? It means the company is delaying the payment to the suppliers. Large account payables may not be always a problem because if the company managed to negotiate a better supplier payment terms. Debts. What if the debt is large part of total asset? It could be, it means the company is highly leveraged, and you got to make sure this debt ratio is more. Debt to operating cash flow is my preferred ratio. Make sure it is less than 500%. If the company has a large debt ratio, you check the interest coverage ratio to determine whether the company has any difficulties in paying the interest on outstanding debt. Or in summary, highly leveraged company is risky. If let's say the company is highly leveraged, plus the company is in the cyclical industry, then I would say that is a recipe for disaster. So what if the economy down cycle, you have to pay back you have to pay the interest back no matter how your economy is doing. Then you might have a problem. Let's say the economy during economy downturn. Okay, what are the other components potentially red flag? If the following items, because you look at the income statement of balance sheet, you know there has a lot of line items. There's sometimes there are other items, such as other receivable, other current asset, other long-term asset, other current liability, other long current liabilities, other intangibles. Because these items, why they are classified as others? Because they are non-conventional. If this number is large in amount, just be cautious. Uh, the company management is hiding something. Need to read in details in the footnote of the annual report why this number is so large. Always be skeptical. And also below items, if the balance sheet item is so large, is compared to shareholder equity value. For example, trading asset security, loan receivable, not receivable. Because let's say the company management has to write down any of these items that will destroy their shareholder equity value. Uh, for example, in the 2023, we have a Silicon Valley bank issues whereby they invested a lot in the long-term government bonds, and those government bonds is much bigger than the shareholder equity. So and it's so smart, so large that the losses cannot the losses enough to cover the shareholder equity, and they cannot uh cover back. So just be cautious. But for us, for non-listed non-financial companies, we have to check this also because some companies also they have spare cash. They invest in uh security. They lend money to customer, or they lend money to some related parties. Just be just double check this. Okay, let me take a look at your question first. Question from Ting. The graphs are very clear. Uh, but we are supposed to plot them from financial numbers over the years. Income balance sheet. Okay. Uh, okay. Are we supposed to plot the chart? Uh, it's up to individuals. Because humans are visuals, graphical visual persons, it's easier to see the trend using charts or graph. So that's why I brought in the chart. But let's say you can read from tabulated values, the trend you can read from tabulated values is also fine. There's is choose the one that suit you. For example, let's say uh in the technical analysis, we always look at share price chart because it's visual to us. But let's say you can read the share price from tabulated form, then it's also okay, but it's up to individuals. Okay, question from Eileen. What are the possible reasons the company will loan money to others which has more than its own revenue? Okay, because the company has large balance sheet, make so okay, I think you're talking about this company, Data Pulse. Take this company as an example. So this company, it have a balance sheet to do so. To lend money to related parties or some other companies. But this company, the sales figure is not doing good. The sales figure is not doing well. It could be this company in the first place when they set up, it has a lot of cash in their balance sheet. But the sales revenue is very small. But because the balance sheet they can afford to lend money because their balance sheet has a balance sheet to do so, then they have a large you can lend large amount of money to other parties. But I tend to avoid what if uh you never know. This company, uh the other party, that borrow money from this company cannot pay back. Oh, and then this will write down the balance sheet and it will affect the equity. But a good thing to check also would need to check this loan receivable as compared to equity. If the equity number is small as compared to this one, avoid at all costs. Oh. So to answer your question, it has a balance sheet to do so, but it has no the sales revenue. It's not the sales revenue. Okay. For shareholder equities, okay, it has a usually has four components. Uh, Ordinary share capitals, additional paid-in capitals, retained earnings, and treasury stocks. Ordinary share capitals are amount of money they raise from IPO. Uh, Additional paid-in capital will be money they pay beyond the par value of price of stocks is during IPO or during the equity raising. That will be additional pay-in capital. Retained earnings will be every year company make profits, and these profits will go to their balance sheet. So they return their earnings. Treasury stocks is happens when let's say the company buy back their shares, and then that will be they'll buy back their shares because they spend cash. Then this will take the cash out of the balance sheet. So treasury stock is a minus figure lah. It's a negative figure. The others are positive, usually positive. Of course, let's say return earnings. If the company making losses year after years, and of course you don't have return earnings and you have return losses, your figure will be negative. Okay, so some companies, their shareholder equity is negative, meaning their liabilities is bigger than the asset. Ah, so why? Because the there are two reasons. Uh, the first one, if the company return earnings is negative, then the negative equity will be negative. This will be bad because the company is still making losses year after year. That's why they have negative equity. But on the other hand, if the company has been buying back a lot of shares, resulting in large treasury stocks, then the equity will be negative. Then this is okay, this is acceptable. So let me give you an example. For example, McDonald's, the shareholder equity is negative. As you can see here from the Optimism AFA, the NAV per share in the blue color here is negative. It's a negative figure, NAV per share. And then why it is negative? Because if you look at the balance sheet, because the company has buying back their shares year after year, that's why you have a negative treasury stocks. Or the treasury stock is negative. But the retained earnings part, you can see this line is positive. McDonald's has been making profit year after year. That's why uh, it's okay to have negative equity because due to the negative treasury stock. So in this case, negative NAV per share is okay. Because negative NAV per shares, you also have negative ROE. Because you know ROE is a function of net profit divided up, so earning per share divided by NAV per share. So because NAV per share is negative, you have a negative ROE. So in this case, negative ROE, negative NAV per share is okay because they have a negative treasury stocks. On the other hand, the other case study, Bath and Body Works, their equity is negative. You can see here minus figures in the dark blue here. And why they are negative? Why the equity is negative? Because return earnings is negative. So the company has been lacking losses year after year. Then the return earnings has been negative, and this is not good. We don't want to. In this case, the negative NAV per share is not good, because the profit is also negative. Huh? Okay, so okay, next will be okay. Next, is a subsidiary, the difference between subsidiary, associate, joint venture, and investment. Because you usually when you go to income statement, you'll find this term. So what are the difference between this term? What is subsidiary? What is associate? What is joint venture? And what is investment? Okay. So direct control happens when the company owns majority of another company's stocks. If a company A own more than 50% of company B, yes, company B is called subsidiary because it has a direct control. So same goes to company B own them more than 50%. But for company C, it own less than 50% of company D, it does not own because it is called what you call indirect control. Huh? Okay, then you may ask, how about does a company A owns a company D? Yes, because you can see here the arrow here is more than 50%, more than 50%. Is a is a control, but it's an indirect control because you have a in between you have a subsidiary. Okay. The shareholders of subsidiaries other than the parent companies are usually defer as a non-controlling or minority shareholders. So in this case, uh, you have a company C is a what we call non-controlling or minority shareholders. So non-controlling interest of minority shareholders refers to the claim of to these shareholders on the profit and net asset of subsidiaries. So because company D is owned by company A indirectly, but in the income statement, in the profits, usually we'll see profits attributable to shareholders and also profits attributable to minority shareholders. So in this case, company C, they also have a claim to the company D profits. In this case, the minority shareholders. So this is why, hence the terms called CAMLA, profits attributable to minority shareholder, profits attributable to shareholders of companies. So, okay, let's go into deeper. What's the difference between subsidiary, associate, joint venture, and investment? Subsidiaries are, let's say the company own more than 50% of the shares. That's why it called subsidiary. Joint ventures or associate is between 20 and to 50% of shares. Investment will be anything less than 20% of the shares. And then what would be the treatment of accounting? From accounting point of view, the listed company has to consolidate all the asset, liabilities, income, expenses into the listed company financial statement. But they have to eliminate the portion that is not owned by the listed company via the share non-controlling interest and minority interest. So for example, just now I mentioned this listed company, they even though company D is their subsidiary, they have to incorporate every profits into their income statement, but there are some part of profits has to go to the minority shareholders. In this case, the company C. So they have to minus that off or eliminate portion that's not owned by listed company. Okay, how about the joint venture and associates? So they have to use equity method accounting. So in the balance sheet, they have to recognize the asset at cost plus any share or profits loss after the acquisition. In the income statement, it has to be share of profit or losses. So any profits that made by this, or any profits or any losses made by these joint ventures or associates, it has to be included in the income statement, and that profits or losses has to be recognized in the balance sheets. And let's say the joint ventures and associates give dividends, then you have to account it in the cash flow statement. On the other hand, in the investment type of uh, ownership by the listed company, And the company just need to include the fair value of the investment. So every year, the company has to revalue the investment they make. Or what we so if let's say there's any changes on this investment, then you have to include account in the, as a fair value in the balance sheet. Income statement, they take into the dividends from the investment, and whatever dividends received from the investment have to be included in the cash flow statement. Okay, let's take a look at the as example, Singapore Airlines. So Singapore Airlines, as you can see here in the cash income statement, you have a share of profits for joint ventures company, share of losses from associated companies. So these are the items that they have. And these items, the share of profits and losses, they have to also recognize it uh, into their as a, into their balance sheet. As you can see here, recognize at the cost, then plus any changes. So every year they have to do the same exercise again. Any loss or profit they make from this acquisition, associates or joint ventures, they have to recognize in the balance sheet. Cash flow statement, on the other hand, they have to, whatever dividend they receive, they also have to recognize it. Yeah. Okay, all of this, okay, not to worry, all this I just for your information. The actual subsidiaries, joint ventures, and investment is for your information. At least you know, we are aware what are the movements in the balance sheet and movement in the income statement looks like from these kind of items. Okay. Okay, so the problems occur when some listed company misclassify their investment as associates. Instead of recognizing the investment at fair value, they recognize it at a cost plus share of profit or losses after acquisition. So they have a different accounting treatment for the ownership. So listed company own less than 20% is called investment, but they misclassify it as an associate. So the problem is that, let's say the investment is depressed below the cost of the investment, below a much lower fair value market price. To make the balance sheet look very rich, they treat it as associate, then that's why they have a high book value. As a result, they overstated their balance sheet in the investment in the. So Noble Group is one classic case. They misclassified that. As you can see here, steady increase in the NAV per share. That asset value to 45%. But you never know, because this company actually overstated their asset in the balance sheet. So NAV per share looks good, net to asset ratio also looks good. Price to book ratio actually is less than 1. Oh, looks very cheap from Noble Group, but you never know. This company, they are overstated their asset. Okay, as you can see here, company balance sheet. Uh, you can see a large part of the company asset, right, is due to the fair value gains from commodity and derivatives. And they also have investment in other asset, in joint venture and associate, as you can see here. Okay, there are two problems here. First problem is a large part of the balance sheet is due to the commodities. This certainly I want to avoid. I look at this, while you big part, the 30+% of your asset is coming from uh, commodity value, trading, contract value. This one I want to avoid because it's a cyclical in nature. The other one is the investment in this Yanko is only 13%, but they treat it as an associate, which is not good. As you can see here, they have a Yanko as an investment, but they treat it uh, uh, as a associate at the cost, even though the market value is only 9.5 million. But in the balance sheet, they treat it as a much higher value. Young call is a 230 million. So this is a cost of investment they make, but the actual market value is like this. But in the balance sheet, they use this figure, the overstated value, which is not good. So it's very, I know it's take a lot of homework to do this, because you need to check whether they misclassify it. Usual investor won't go into this detail to check whether you misclassify the investment as associate or not. Is not usual case. But it's good to check this one, because you never know. Because the company, the price to book ratio is so low, then it's a question mark. But first thing first, you look at this uh big elephant in the room. Large part of the asset is in the commodity contract value. This is something very cyclical in nature. Okay, so in summary, always investigate the balance sheet items and always check which part of the balance sheet items is the largest. So it could be, just now in the noble group, is a commodity trade contract value. It could be cash. Cash, of course, is good, but you need to check whether the company is matured, or are they, what do they do with this cash? Do they invest in the short term uh, uh, T-bills? Because short term T-bill is considered as a cash and equivalents. And do they also have maybe they have a large part of asset in the property, plant, equipment? Then you need to check whether company is capital intensive. So always checking the balance sheet items help you understand how the business it will help you appreciate the business better, and check whether the goodwill is growing as significant despite ROIC or ROE going down. Check if the negative equities is due to large uh, accumulated deficit or negative return earnings. If the company has insufficient asset on its balance sheet to support its operation or revenue as reported, compare with the industry peers and compare historically, and check if the company misclassify their investment associate, and book value is much bigger than the fair market value of investment. Yeah, so for balance sheet, it's a lot of works to do, because the balance sheet you have many items as compared to income statement, but it's always to check to the large items because definitely we don't want to lower, we definitely don't want to lower our risk, especially let's say you make 6 figure investment into one stocks. I think better worth an effort to check these are the balance sheet items. Okay, so question from Eileen. By the by this definition, does it mean Great Eastern is subsidiary of OCBC? Yes, Great Eastern is a subsidiary of OCBC because it's more than 50%. Yes. So in the OCBC income statement, there will be the income statement will have two parts. The profits attributable to uh to the shareholder company. The other one is to the minority shareholders. If it's a minority shareholder of Great Eastern. Okay, I think for next two topic I will cover after lunch. I know this morning a lot of heavyweight topic. So maybe we can have a slightly longer lunch. After the lunch, maybe we will cover the rest too, and we do some class exercise, and we can cover some case study. And if you have any questions to the listen market, please feel free to post in the chat, and we can discuss in details, because we have we have ample time today to talk about those topics. So in this case, maybe I take a look at time now is 11:59. Let's come back at 1:15 p.m. 1 hour and 15 minute break.
Okay, and for whoever requested for the notes, I already sent to you already. You can also follow the instruction given in the chat box. Right. any constraint, talk to Dr. T. All these are excellent materials. In fact, in the afternoon, this will be the meat. You'll see the applications, for example, in two new giant stocks, right? And as usual, at the end of BA4, do stay late for another 1 hour. Dr. T will give a bonus talk using AutoWeb, relying on the latest case studies. Okay, lah. So come back 115. Huh? Any Q&A, you can type in the chat box 115 when Kilim is back, they can answer to you. Okay, so what I'll do is I'll pause the video recording later on. Kilim remind me to resume. Let me see, pause, yes. Okay, let's continue with the afternoon session of the BA4. Go ahead, Kilim.
Okay. Thank you, Dr. T. Okay, let me take a look at the questions you guys have. Okay, one question from Ting. Will you clarify significance of classifying as association or uh, clarify again? Okay, you would like me to clarify again? Okay, sure. Okay. So I think I will go back to the table over here. I think this one. Okay. I think just the key takeaway from this slide is that some company misclassify the investment as associate or joint ventures. Uh, uh, so investment means it should be less than 20% of the share by the listed company. Associate means it should be less, it should be between 20% and 50% of the share ownership by listed company. So some company misclassify the investment as associate and joint ventures. So the difference is that the accounting, there will be accounting recognition, different method of accounting is used for these two type of entities. The first one will be the investment should be because it's an investment, balance sheet should only recognize at a fair value. So that means when the company, let's say Singapore Airline, go and purchase the other companies, and this company, it own less than 20% of this company, and every year Singapore Airline has to check what would be the fair value of this investment, and then in their balance sheet they have to update the fair value, have to update the investment up to the latest fair value. But if let's say Singapore Airline recognize this investment as a joint venture or associate, that it means they do not need to recognize every year at the fair value. They just need to recognize the that investment they made at the cost of the investment. Let's say the Singapore Airlines purchased 100 million of this investment, and at a cost, then that means will be 100 million every year, plus minus the profit or loss they made from this acquisition. So it is investment every year will produce profits or produce losses. So those profit or losses from the has to be included in the balance sheet. However, on the balance sheet, however, when it goes to investment, it has to recognize the fair value every year. So it's not 100 million every year. It will change based on the market price. Okay, so the worry about this one is that if the company purchase the investment at much higher cost, then this investment go down in value every year. But in the balance sheet, let's say they misclassify as a joint venture, balance sheet will only show you the value at a cost. Mostly at the cost, plus minus every year small changes in the profit or losses. But in actual case, because the investment value go down every year, then it kind of overstated the asset already, or the asset value is overstated because does not reflect the actual investment fair value. Okay, this in my opinion, you only need to check this if let's say the company has large uh, part of the asset in the investment or associate and joint ventures. This one you need to check. But let's say anything less than 10%, maybe not need to check, because you just need to focus what is important in the asset. So it depends case by case. So for um for my case study here, no, the Noble Group, the Noble Group, I would say that if you look at the balance sheet, large part of the assets comes from the fair value gains on commodity and derivatives. Is their commodity contract value. So this made me very uncomfortable because commodity price changes from time to time, and the fair value can affect wildly when it volatile. So the asset value, we do not know whether uh in next year the fair value will be the same. Is very risky. So for me, from commodity firms, I tend to avoid investing in commodity trading firms, because it's very dangerous. Same goes to companies that do livestock or uh, plantation. So the price of their asset, the price of the plants, the agricultural products, livestock products also uh, is in the mercy of the global commodity price. Is very, to me, I don't feel very comfortable. But it really depends on individual. But let's say you want to invest into a company, you must understand the industry very well. Uh, so in Noble Group, they have a large. This is a big elephant in the room. But they also have investment in joint venture, etc. This one is only 5%. For me, in the first, I won't check this out because it's less than 5%. But this case study, I just want to illustrate you because this company, they misclassify the investment as a associate or joint ventures, the overstate their asset lah. Yeah. I hope this one clarify your question. Okay. Yeah. So these are the key takeaways from the aggressive balance sheet management. Okay, topic number 6 related to business and finance is check whether there's a significant guarantee under commitment or significant contingent liabilities. So we know that leverage is a double-edged sword. If the revenue growing at the company with high operating and financial leverage, the operating profit can grow much faster. When the company business model fails, sales force, leverage can magnify in losses. So yeah, so let's go into income statement. So when the sales drop, uh, provided all else equal, earnings will drop. Because earnings will drop, the equity retained earnings also drop. And because earnings drop, let's say 1 to 1, let's say 100% of earnings convert to cash flow, then the cash flow also drop. So the balance sheet is equal. Then some company enter into a commitment and contract may require payment over long period of time. So such commitment or contracts are similar to borrow money. They are not be obligated to report them as debt on the balance sheet. So usually commitment or contracts, uh, uh, they they put in, let's say they want to invest to expand their building. They have committed to that, but they haven't spent the money. But this is a commitment from the company. Is similar to borrow money, so they have to. Uh, they are not obligated to report because they haven't incurred yet, but it's a commitment to them. So we need to check whether is there any in the footnote whether they have any significant guarantees, commitment, only or any special arrangement such as special purpose entity, special purpose vehicle. or by the parent company to accept. Okay, this one, special purpose entity or special purpose vehicle is usually not a bad thing. Sometimes it can be good, sometimes it can be bad. Uh, Good as in, let's say Disney company, they want to expand their theme park business. Let's say want to set up Disneyland in Singapore, but they do not want the market to know this because they are a public company. Whatever they do, they have to disclose this. So what they do, what Disney will do, they will set up a special purpose vehicle or special purpose entity to do uh uh the work to set up the Disneyland in Singapore, so that this activity is not need to be disclosed in the public because they want to make it secret. Uh, and then but it's a future. In the future, let's say the Disneyland is set up, the theme park is set up, then they will inject this special vehicle that we will incorporate the business into their listed company. So in a way, it's a kind of like a trade. We will say, I don't say it's trade secret. It's a confidentiality, business confidentiality, but in a way they want to expand the business, but they will just do it secretly. But in other company, they will do. That example would be they try to hide the debt. So let's say the listed company has a lot of borrowing, but they know that the investor don't want to see so much borrowing into the listed company. What they will do, they will sell this borrowing to special purpose vehicle. Uh, and so that it makes the balance sheet looks good on the public side, on the public company side, but actually but they have a lot of commitment to this special purpose. There's special arrangement with special purpose vehicle. They they hide a lot of that, so that could happen. So what you need to do is to really understand, uh, go to annual report to understand what is the financial credit arrangement they make. Usually they will indicate you, they say they make some debt arrangement, or they will do some business expansion. They have to disclose this. Okay, contingent losses or contingent liabilities, such as legal, patent, tax regulation, environmental, pension-related claims, warranty claims, derivative commitments. So all these commitments, the company has to uh, have to fork out the money sometime in the future, but is not part of the company balance sheet yet. Uh, Commitment, special purchase commitment with the supplier, capital commitments with purchase asset, decommission plans, construction commitment, third-party guarantees, and licensing agreement. This is what I say, commitment to expand the business. Uh, or any provision for liability and charges. So all these four. So go to the annual report, search for the keywords: commitment, contingent, guarantee, provision. I always do this. Whenever my friends tell me the uh, new ideas, not only I check the financial numbers, I will check these four keywords. Apart from revenue recognition that I have told you just now, uh, also I will check the commitment, contingent, guarantee, provision, to make sure the company is clean. Uh, of course, company will have commitment that depends case by case. Let's say they are doing some commitment to expand the business, I think it's okay. Uh, so significant guarantees under commitment, contingent liabilities or equivalent in the footnote. There's a red flag. Or revenue from unusual type of customer, financial service company. Uh, so which is the sales revenue coming from non-core business. Okay, this case study on Rolls-Royce. So Rolls-Royce actually provide financial support about 2.8 billion for its customer. This is an off-balance sheet arrangement. This is not stated in the balance sheet, but they have this arrangement with their customer. So something to note. So you need to check, okay, this is their commitment to provide customer. Is this figure huge enough as compared to the total balance sheet? Okay, shifting account receivable to special entity to make the balance sheet look stronger. So some companies shift account receivable off the balance sheet. So this is a listed company, and they set up the company X, a special purpose entity, but they control less than 50% because in this way, company do not need to consolidate balance sheet of this company to the listed company to make the listed company looks clean. But what they do is that they sell account receivable at discount because this listed company has a lot of account receivable. They sell it at a discount. It's actually called as known as factoring. Okay. Okay, so to let this company to bear the credit risk of collection, and then because they sell it at a discount, they receive the cash. So as a result, right, because the company sell it to this company X, and then they receive cash, they record this cash as a revenue, and they also make the cash position look stronger. So account receivable drops, then cash increase. Okay, so some company do this, but just to make sure this activity is not huge as compared to their total sales. Uh, so as much as possible, uh, probably listed companies should avoid this because why they want to do some the things that are outside their competency. And usually company with high receivables will do this. For example, let's say earlier on this morning we studied the financial ratio called DSO, days sales outstanding. We know that more than 180 days is gone cash. We will not touch into those company. So usually company with very high DSO where they tend to do this. They sell their account receivable at discount and receive cash and to make their cash position look stronger. Okay, so some listed companies shift their listed asset off the balance sheet to a special purpose entity, and gain from asset sold is recorded as a profit and income statement. And some other listed company use this SPE to borrow aggressively to fund the asset purchase. And through this way, listed company can hide large amount of debt in SPE, show a stronger balance sheet, and which is a creative way to borrow funds and reflect as a sales. Some listed company even provide capital to lending party in order to continue record as a profit in the end. So another diagram, so listed company own less than 50% of the company X, and this listed company sell distressed asset or distressed investment to this company X, and then receive cash, and they record it as a profit gain from this company. Yeah, so let this special entity to have large debt position. And worse, some of these listed company use a very creative way. Because their cash has a lot of cash, then they inject capital to a bank or third party lender, and this third party lender go and inject cash to this debt, a company with high debt, and then this high company, so that this company can continue uh, issue, borrow more cash from the bank to secure the operation. These are typical uh, fraud case. It's not mainly turned into fraud, but it's typical fraud case that they try to make the listed company looks cleaner, but at the end they hide a lot of debt, off balance sheet, debt into other companies, and then they also inject another capital to another lender, and the lender can continue to support this company X. So for us as as an investor, we check what we can check in the disclosure given by the company. Check whether there's any significant guarantees under the commitment, contingent liabilities, or equivalent in the footnote. Yeah, so a classic case will be Enron. In US, it's 2 decades ago. As you can see, Enron, it has a very inconsistent ROE, but in general, the EPS is go up. This is a one-time expenses they have, but in general, their EPS is going up. Cash flow also going up. Debt to asset ratio is less than 15%. NAV going up. Revenue going up. Dividend going up. So AFS score they are quite good. But there's a danger behind. This is how the Enron made their balance sheets looks strong. Yeah, so this is what I illustrated just now. So Enron, they set up a special and purpose entity. They sell a lot of asset, distressed asset to this special entity, and then uh they also ask an investor to provide capital to this special entity. Oh, and this investor also got the capital from Enron, and then same goes to the lending group. So in a way, they do this kind of things year after year, and until it was become unsustainable. This is a complete. Uh, they actually set up 500 SPE, special purpose entity, to do this kind of fraud activity to hide their loans and distress asset. And if you go to their annual report, actually they have indicated to you is a guarantor of certain liabilities for unconsolidated equity affiliates and other companies totaling 1.8 B in the year 2000. So it tells you the company has a disclosure. So a lot of people miss this. So there has a commitment uh, on on the certain liabilities already. So when you see this guarantor for certain liabilities, I think uh, better escape from the investing in this company. As you can see, the stock chart, it hit about 90 plus in the year 2000. After that, uh, it becomes 26 cent. Uh, then the company went bust. Yeah. So check if the company has a financing, significant guarantee arrangement, or contingency disclosed in the footnotes. Always check this. Okay, the number 7, check the dividend payout sustainability and compare the dividend capital raised with the capital return. Okay, some companies pass off some of the earnings to the shareholder as a dividend, where others prefer to reinvest all their earnings into company. So for companies that give dividends, we always check the dividend per share historical trend, and usually the rising dividend per share is a good sign, because rising dividends means the company can he has an improving cash flow, he has an improving profit, and he has an improving sales. So dividend per share historical trend for past 5 or 10 years, let's say it's going up year after year, is usually a good sign, because it shows the company is thriving. But of course, we need to check the sustainability, because we know that dividends are paid out of free cash flow. So we always compare dividend per share and free cash flow per share. If the free cash flow per share is less than dividend over a long term, that means the company pay more dividend than free cash flow. Then that means the payout is not sustainable, and there's a risk of dividend cut, and there's a risk of no dividend growth in the future. So company has to finance this dividend payment. They have to pay their debt, they have to reduce cash on hand to give you dividend. It's not sustainable. A more sustainable way is to have dividend more than cash flow more than dividend over long term. It means the dividend payout is sustainable, and there's also a chance of dividend growth. So red flag will be free cash flow less than dividend over the past 3 years, and beware if the company has high amount of debt. Okay, past case study in the StarHub. You can see StarHub average dividend year in the past was very high, above 5%. Oh, despite declining dividend, you can see here 2016, then they reduced the dividend, but it's still high dividend yield. But if you compare the dividend per share and free cash flow per share, and most after year 2013, the dividend per share is more than the free cash per share. It tells us that actually the dividend payment is not sustainable. They have to cut dividend, or they have to find ways to finance their dividend payment to maintain the dividend payout, and then while the free cash flow is not there, is difficult. So that's why in 2017 they have to cut the dividend because the free cash flow cannot give them the avenue to pay dividend. Of course, TTM after I think after 2020, I think the situation got improved for Starhub. So free cash flow over dividend in this period is okay, but free cash flow over dividend, that's why okay, that's why the share price does not move much. And you have a dividend cut here, you have a dividend cut here. So even though here you see the Starhub dividend yield was very high, uh 5.6-7% dividend yield, but after you examine closer, you found that the dividend payout is not sustainable. There's a risk of dividend cut. So I think that's why there's a okay. Also facing the same thing. That's my opinion. Singapore Airlines in the past used to have negative free cash flow, but last year they have positive free cash flow. Why they have positive free cash flow? Because their capex is low as compared to historical norm. Uh, uh, so my question is that why the capex is very low? Do they need, is it because now these days the aircraft require less maintenance, that's why the capex is very low, or maybe they purchase less aircraft? So in my opinion, I don't think so. I don't think they will maintain less aircraft. I don't think the aircraft today is less maintenance because aircraft you have a checklist, you have a lot of maintenance work to do. So I think they are under spend in the capex. So I believe Singapore Airlines right now having a high dividend yield, 5.6-7%, is not sustainable. Uh, because I think in the future the free cash flow will be negative, and then there will be a dividend cut. And also, airline is a competitive industry, and then they fight for price, they fight for passengers. So it's not easy to earn a good profitability in this industry. So just a matter of time. That's my opinion on Singapore Airlines. Yeah, because recently my friend asked me about Singapore Airlines, and I checked, I found out this issue lah. So just my sharing here, my 2 cents. Okay, Starhub, back to Starhub. As you can see here, the debt is more than the cash. How they borrow money, a lot of money. Then also they pay a lot of dividends, then their free cash flow. So these two, it shows me that the dividend cut, the risk of dividend cut is very high. That's why in 2016, they cut their dividend. So if you have a cost materials today, you will get a list of company that with dividends paid more out of the free cash flow over the past 3 years. So or listed in these exchanges, companies, list of companies. Okay, the next topic would be other than dividends, some company in actual case they raise more capital than return the capital to shareholders. So uh so in on surface, it seems like listed company give back the shareholder capital as a dividend on as a capital deduction. Capital deduction means they are buying back their shares as a form of capital give back. How the company can raise the capital from shareholders? From right issues, from share placement. I will prefer right issues because everyone has a chance to take part. Share placement is only dedicated to certain group of investors, usually institutional investor. To protect shareholder over a long-term interest, make sure the total dividends exceed the total amount of money raised over the past 5 years. And actually, it's not just total dividends, but also the share buyback. So total capital raised by the company, let's say it's more than the total capital return to the shareholder over the past 5 years, then it's a red flag. Meaning, in other words, it means listed company keep asking shareholder for money from right issues, from share placement, and this amount of money is more than the dividend they pay to shareholders. If they do this over the past 5 years consistently, then it's a red flag. So you actually you ask money from shareholder, ask more money than shareholder, but you pay them very little. Huh? So this company, back to this company, Electech Lifestyle, it's a footwear company. So as you can see here, common stocks issues is right here. They raise the fund from shareholders, but the dividend pay is very little lah, over here. So they ask more money from the shareholders. Then they do their balance sheet very strong, but they also pay very little. Yeah. So another case study on Enron. Enron, you also will see uh issues of stocks. Is about this amount. Then capital return as a form of share buyback or dividends. This is dividend. Is also this amount. You can see here asking more capital from investor than the paying back. Oh, yeah. So it's actually a red flag. Oh. So issues of stocks. If the company keep issuing, we keep raising capital by issuing the stocks. We need to check the average shares outstanding, the number of shares outstanding trend. So if let's say it's consistently uptrend, we need to ask why. Or is it capital raising, or is it due to the company has large stock-based compensation and they keep issuing shares to their employees? Okay, what I will check is that I will check the trend of the total share outstanding, and I also check the free cash flow per share. I want to make sure that the free cash flow per share the company can generate faster than the share count. Yeah, if the number of shares increase faster than free cash flow increase, that would dilute the shareholder interest. Let me give you an example later. Okay. Okay, I don't have example. That means later on in my case study, I will have example. That means uh the free cash flow the company generate uh is amount of cash profitability the company can generate. We want to make sure this number can grow faster than the number of shares the company issues. And you know the share price tend to follow the free cash flow per share. So if the free cash flow rise faster than the share count, then the share price should do better. So if let's say the free cash flow grow, if the share count grow faster than free cash flow, that means the free cash flow per share will keep dropping, and that is not good for the company's share price. So in summary, we check if the company has paid more dividend than free cash flow, and we check if the company has raised more capital from the shareholders than actually return it. And we check if the free cash flow per share rises over time. Free cash flow per share is one of the AFA. So always check this to make sure this number is going up. Okay, let me take a look at your question, whether you guys have questions. There's no question. Yeah, and if not, let me go to the class exercise to practice what we have learned so far. Okay, let me share my screen again. Okay. Okay, again, there are 3 questions here. Each question has 4 choices. Choose the best answer. Question 1. What is the best financial ratio to measure the ability of the company to pass along price increases through sales to customer? Gross margin, quality of earnings, C, operating margin, or is it D, return on invested capital? Yeah. This financial ratio will show you the company has a pricing power to pass the cost increase. Yeah. Okay, you guys got the answer right. Actually it's gross margin, not quality of earnings. Yeah. So gross margin is a good tool to measure the company pricing power. A rising gross margin is the best to see. It means that it shows the company really can pass cost increase to the customer. And at the same time, they can manage their cost very well. If we look at Singapore study, case study, Sheng Siong, our supermarket business, if you look at gross margin is rising and very high as compared to other supermarket. It shows that Sheng Siong has some strength. Uh, uh, it can pass a price increase to the customer and it can manage their cost very well. Uh, which of the following is acceptable for investors? Significant contingent liabilities, significant guarantees and commitment, negative equity due to large share buyback, low return on invested capital. Which one is okay for us as an investor? Oh, yes, you guys are right. The answer is C. Negative equity due to large shares buyback is okay. Now, or negative NAV per share is due to large share buyback is okay. If negative equity due to large retained losses, then that's no good. As a dividend investor, we often compare dividend with what to check the payout sustainability, financial cash flow, free cash flow, asset value, or share price. Yes, that's right. You guys got it right. Free cash flow. Yeah, so we always compare the free cash flow and the dividend to make sure the dividend payment is sustainable. Yeah, as a young company, I prefer usually for me, I, I'm more to like a dividend growth investor. I would like to see the company can grow dividends over time. And one of the criteria for me, to see the free cash flow is at least double of the dividend payment. That means there's a room for dividend growth in the future. But at the same time, I want to see the company can grow their sales revenue figure over time. Yes, for me, dividend growth investor. So for uh, it's okay to have some dividend stocks that is companies which is matured. They pay almost all their free cash flow to dividends, but there's very little room for dividend growth. No. Okay, I think that's all for uh the question. Okay, question from Linton. Uh, how about dividend payout ratio? Was it okay? Okay, dividend payout ratios. I will compare dividends per share and free cash flow per share. The conventional way of a dividend payout ratio is to compare dividend per share and earnings per share, which is also okay. But I would prefer free cash flow per share for the dividend payout ratio, because dividends are paid out with free cash flow. So what would be the ratio to look at is usually less than 70% is okay. We prefer to be less than 100% because you don't want the dividend to be paid more than free cash flow. But to give us some room for growth of our dividends, I prefer it to be less than 70%. But of course, not all the stock I have this characteristic. All the dividend stock I have, some dividend stock I have more than 90%. For example, REITs, real estate investment trust, they will pay 90% of their free cash flow, of their cash flow to as a dividend. So it depends case by case. But you look at the for non-REITs, non-financial companies, uh, for growth, dividend growth investor, I prefer it to be less than 70%. Even if I have a large, okay, question, even if I have a large retained earnings, okay, large retained earnings, okay, okay, so now we are missing the balance sheet into the picture. Retained earnings is the retained retained past profits. Uh, it's a past cash. Large retained means meaning usually will have large cash balance. Uh, even let's say dividend payout ratio is high, meaning or maybe more than 100%, they are pay out more than free cash flow. But if the company has a bad balance sheet, has a strong cash balance on the balance sheet to pay you dividend, I think that should be okay. Maybe for 1-2 years should be okay. But not over a long period of time. So if the company cash back on the balance sheet, uh, usually large cash balance sheet is due to the large retained profits. Uh, but make sure the company, but first make sure just now you learn that make sure the company has very low debt ratio lah. You don't want to company to over leverage, meaning the debt is more than the cash, and they still pay more than 100% of dividend payout ratio as a dividend. I think that is not sustainable. Okay. I think I'm almost done. Next will be my case study already. But feel free to ask any question from time to time. Let's say you have any burning question related to listening, market, I'm okay to answer. I will do my best. So without further ado, let's go to the case study. Case study one is a listed company in Australian exchange. It's a WiseTech Global. This is a software company for global logistic companies. Software for logistic company. It's a leading Australian software company specializing in cloud-based solution for global logistic industry. Founded in year 1994, headquartered in New South Wales, and serve over 16,500 logistic organization across more than 190 countries, including significant majority of top third-party logistic providers and freight forwarders. So what is the company vision? The company vision logistic. So it helped the logistic company to save costs because usually in the past, logistic company they tend to have their own software, and more often than not, their software is very do not have enough information about the flow of the logistic, whether their containers, the cargo ships uh, are either maybe how to make efficient use of the cargo ship or other logistic. But this company, I will show you this company come into place how they help the logistic company to be more efficient. So they are leading developer and provider of software solution for logistic company. Okay. Their flagship platform is called CargoWise. It's an integrated cloud-based software solution that allow logistics service provider to manage their operations, such as executing logistic transaction, tracking shipments, handling documentation on one single database. So they support multiple users, function, officers, corporations, currency, countries, and languages. So as you can see here, there is a operating system for global logistics. They have a data from domestic logistic service provider. They have data on warehouse, custom, uh, the freight forwarding, the custom office, all this. So they have the entire change of shipments or logistic service. They have all the data. So they will tell whatever logistic partner whether do they have any idle or vacant warehouse. So that maybe the logistic partner can say maybe logistic company A, they tell me, hey, I have a empty warehouses, but I think I can rent this later house to other company B. So cargo wise, fortunately we have cargo wise can have this data information to tell various logistic partner and how they can make efficient use of warehouses. Not only that, they also have the data of all the different logistic data. Especially recently, we have a trade war from US, a lot of tariff being set up. This will create a mess in logistic industry. So I think the logistic company need this CargoWise software to check what would be the best way to cut costs for to deliver the products or goods to the other party, and what will be so that the entire cost could be lower because they have data, all the data from the various logistic service provider. Okay, what is the value proposition? It's a single integrated platform. They enable all the parties to manage the entire supply chains, including the freight, forwarding, custom clearance, warehousing, and more. And they provide the real-time data. Okay, the problem with current uh, in-house uh, software we have, okay, currently, let's say company do not have this platform as a to manage their supply chain. Usually company use their legacy software, and their legacy software is not real time. So they do not know whether their ship is idle there or their warehouse is idling there, and they cannot make efficient use. But by having this platform, you will have the a quick view like a dashboard to see the entire logistic or forwarding, the custom clearance of warehousing, all this. Okay, so the solution is replacing the aging and legacy system with highly automated integrated platform that support global operation, multiple currency languages, and regulatory environments. Enhanced visibility, provide real-time tracking, workflow management, give the companies greater visibility and control over their logistic operations. If I'm not wrong, I read, uh, I think only less than 10% of company, logistic provider, this company today, uh, use their uh okay, at least 90% the other way. At least 90% companies still using their legacy way to manage their supply chain, which is very efficient. So there's a lot of room for growth for this software provider like the WiseTech Global. So what are the benefits this company can provide for both freight forwarders and asset operators? So what are the freight forwarders that are that? For example, DHL, Nippon Express, DSV, they are the core users of global logistics. So what WiseTech will do, they consolidate various functions, freight forwarding, custom warehousing, accounting, and provide real-time visibility into the shipment data for this company. And this company do not need to manually track and trace good shipment movement, and hence save their labor costs because it's done automation now. It's done automatically. And they can also allow this freight forwarder to choose asset operators from the platform. So what are the asset operators? Asset operators, the company, companies that own truck, company that own ships, own airline warehouses. So example would be like Emirates, they have a aircraft, Costco, they have their cargo ship, they have their ships, and so same goes to these shipping companies. And this sometimes the problem with these shipping companies that their ships are idling somewhere, and they do not know the way to make efficient use of them. That's why they have to, if with this platform, they can approach a freight forwarder company like DHL and Nippon Express. They say, hey, actually I have an idle ship. Would you like to use? And then at some cost, then of course freight forwarder maybe they have an over demand of for goods, and they can make use of this ship. So in a way, it will make efficient use of asset, no? Better utilization of the asset, and also they have a real-time monitoring of their drivers. Where is their ship? Where is their driver? Where is their container? And it's a real-time monitoring. So unlike currently, most of the companies are still doing manual work, or it's not a real-time monitoring. And there's a better collaboration and connectivity with freight forwarders. So this platform is all in one, everything in automation, and you have a both party collaborating with each other. So who are the customers? Currently, their customer base include 24 out of top 25 global freight forwarders and 43 out of 50 third-party logistic providers. So these are the list of customer they added over the past few 2 decades lah. So you have a DSP, so you have DHL over here. So those marked with 25 means they are top forwarder. So you also have a UPS, Sinotrans, Nippon Express. So these are recently added customer. Okay, in terms of financial analysis, it's an unqualified opinion, so true and fair view. In terms of AFA, EPS uptrend in green color here, ROE 16%, which is double digit, which is good. Cash flow, okay, and also the trend is also steady. There's no sign of going down. Cash flow positive and rising. NAV rising and increasing, positive NAV. Net debt to asset value is 3%, very strong in balance sheet. Dividend per share every year increase dividend year after year, revenue keep rising. So I will say this company have a perfect AFA score. In terms of profit margin, gross margin 85%, 80+% gross margin, which is a wonderful business. Operating and net margin are double digit, and also over time is rising, you can see here. Quality of earnings, more than 100%, has more operating cash flow than net profit. Return on capital, double digit and stable, I can say is stable, which is good. Double digit return on capital is a good sign. Company has more cash than debt, that's why it's a net debt position, is a negative net debt position shown in balance sheet. Dividend, they pay out dividend per share less than the free cash per share. So there's a room for growth for dividends. If they would like to increase the dividend, they can do so. Dividend payout ratio less than 20%. Yeah. In summary, I would say all are good for financial numbers. Business model, this company business model is mainly subscription. It's on-demand license revenue. So recurring on-demand licenses, software as a service, and how the billing looks like, it built on monthly basis. Other than that, this one, the OTL maintenance revenue is charged when it's needed. But it's only small amount of the total revenue. Business model value change. Vistek Global, their suppliers are software providers and engineers. They make the software platform, and then this company sell the software service via subscription and maintenance service on demand. This one. Numbers of enterprise customer also increased over time, over the past decade. And this company has a very high retention rate, as you can see here, less than 1% attrition. So which is wonderful. More than 90% of the customer, at least 99% of the customer keep using the what do you call it, their platform. I so far I don't find any similar platform, any competitor platform at this scale that can cover wise by this company. So low attrition rate, and top 300 customer deliver 70% of revenue. Revenue base, I think it's quite diversified. So as you can see here, top 10 customer occupy about 25% of the sales. So it's quite okay. 8% is our next 10, and then the rest company is 67%. In terms of geography, I would say you see it's quite diversified geographically. 35% from Europe, Middle East, Africa, and 28% from APAC. Then you also have America, and 37%. In terms of economy mode, I don't think I would say the additional intangible asset is not there. Maybe the company has branding, uh, it has branding by itself. But to be more conservative, I say no. Uh, but the switching cost, I would say yes, because customer has a high retention rate, and then given the high upfront capital expenditure and mission critical nature of the product, once it's implemented in customer system, the customer will be very reluctant to switch the providers. And there's no other provider at this scale, as far as I am concerned. Network effect. Uh, Freight forwarders typically they select and coordinate with asset operators. And this website is that the more asset operators, the more freight forwarders integrated into their platform, the higher, the more benefits it will have for both existing and new users. And moreover, all these parties will have a very good visibility, real-time visibility on their supply chain or on their goods shipment. Cost advantage, you can say yes, maybe no, because at this company, at these skills, it can actually every incremental uh sales they make, because it's a software company, software product, every new software product you create for new customer is the cost is actually every incremental cost is actually near to zero. So that's why they can keep very high gross margin. I would say there are some low cost advantage here, but to be more conservative, I put no here. There's no efficient scale. It's not a big, it's not a small market, it's a big market. That's why there's no efficient scale. Competitive risk, of course, the company has some risk. There are some legacy providers. Because this company also compete with other software, enterprise software providers. Because this company also provide ERP and enterprise software, enterprise resource planning, supply chain management and transportation management system. SAP also doing this. So they also compete with SAP. And also logistics software providers such as uh, Descartes. I don't know how to pronounce this, but they also have other software provider, but it's not at this scale of by this company. Industry risk. Okay, I would say the logistics industry is still in early stages of digitizing, and there's still some uncertainty regarding what will be the ultimate market opportunity and adoption rate. But I think this is also opportunities for this company. Although a lot of legacy logistics provider are still using their own system, but at times goes, company will get digitalized, then they will switch to this platform. The only problem is uh, they because we do not know, it's still young, a lot of things could happen moving forward. So uh, it's usually happen in a young industry like this, young software company in the logistic industry. You do not know what will happen in the future. Maybe there are some disruptor coming, but so far I don't see it yet. But we cannot exclude this risk. Geopolitical risk, I say no. Government risk, I say no. Concentration risk, I say no. Leverage risk is no. Management risk, yes, I would say there's a key person risk. The founder is the CEO of the company, is also the chairman of the company. So it's also the largest shareholder of the company. So, and this founder and is a Richard White. His name is Richard White. There could be a long-term succession plan. And recently, the share price took a hit during April, but it has recovered very fast. Because when I created this case study, the share price was still depressed, but it recovered quite fast from there. Because there was a concern on the overpower of this by these founders, and some board members have quitted from the board, and because Richard White actually in the past he 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 gave away his CEO role to other persons, but now he came back because the CEO didn't want to involve, and then this founder came back. But which is a good thing. The founder coming back to be a CEO, which is good. But there's a concern on his over dominance in the company. But I'm not too worried because he's a founder. And this company is his baby. And I think the company will do well under him. Okay. Growth drivers. Uh, digitizations of logistic industries. So logistic industries currently operates with very low level of digitization. Many logistic providers are still operating on fragmented and outdated system. And this presents a large opportunity for WiseTech. And there are also and moreover, right, these days the supply chains getting more complex. We have a trade war. In the past, we have COVID. So more and more companies would like to uh, have a better visibility and better efficiency in their supply chain management. In summary, very good business model, very high customer retention rate. Sales are quite diversified geographically, high switching costs for the customer, strong network effect. Some uncertainty whether the logistic industry will go digitalized, key person risk. But I think the risk is quite low, in my opinion. Uh, Growth drivers, so logistic industry will get digitalized. Okay, in terms of red flag analysis, what we have learned today, just let's practice what we have learned today. Number one, we look at DSO. So the DSO, day sales outstanding is quite stable, stabilizing at the 50 days, and also the absolute number is less than 180 days. So this is okay. They can receive their cash within 2 months. I think it's okay, and it's quite steady. Largest share pledge. Largest shareholder is the founder, but the company the founder own about 38% of the shares. Oh, sorry, this is a voting power. I cannot remember exactly how many percent, but it's a larger shareholders. But so far, I couldn't find the information whether he pledged his shares. Also, there's no data. Related party transaction, yes. The founder of the company has an office, and this office is not under the company name. So he's actually leasing this office to the listed company lah. But I checked this figure is only one M, 1 million Australian dollar. It's not huge, so it's not a concern for me. I'll be more concerned, let's say it's more than 10% of their total cost. So to me, there's no sign of uh, concern. Okay, let's analyze the earning and asset. This company asset, you can see here, in the balance sheet, large part of the asset. So you have a 2.8 B in the asset value, but 2.4 is coming from intangible asset. So there's a large part in the intangible asset. And this company is an asset light, as you can see here, is the PPE, the property plant equipment is only is a small figure. So let's examine what is this about. Why the figure is it worrisome? And as you can see here, large part of the intangible is in a goodwill. So it is very scary. So more than 50% of their asset is in the goodwill. Because this company has been acquiring other companies to grow their business and integrate new technologies. So more than 50% of the asset is in the goodwill. But let's examine their return on capital. So just to show you the high good to asset ratio, goodwill to asset ratio. But you look at the return on capital, it has been quite steady at 10% plus. There's no sign of going down. I think for this moment, it should be okay. I will be more worried if, let's say, the return on capital or return on equity keep dropping year after year. It shows that the whatever acquisition they made is no longer promising, no longer delivering their return. But so far, I will give a go for this company for the high goodwill. Okay, I also analyze the the other items in the balance sheet. So you can see here, uh, other receivable, other current asset, other long-term asset, other current liabilities, other non-current liabilities, other intangibles. All the other items is less than 10%, except the intangibles, which is related to their goodwill and software. Then whether the company making any loans? No, the company do not make any loans to any parties. Any deferred charges? No. Any very small amount. So you can also do the same for your case study. Let's say you can go to the company balance sheet, and then you do the division, like what I'm doing now, and you can check whether these figures are worrisome. Or I will be more worried if they say this I will need is let's say it's more than 10%, and uh it and you need to look at the footnote of the company and check what is going on. Okay, any commitment or contingency. Uh the company has made some capital commitments, which is very small amount, and there's no guarantee, there's no contingent asset or contingent liability, so it's okay. Dividends and shareholder capital, if you look at that, the free cash flow is way more than the dividends paid and way more than the share buyback lah. And the number of stock issues is also smaller than the numbers of total amount of dividend paid and buyback. So this company return more to shareholders than the asking from the shareholders, and the free cash flow can cover the dividend paid. Yeah. And okay, because it's a software company, I will do additional check on the stock-based compensation. So stock-based compensation over the years is quite a small figure, less than single percentage, which is okay. Okay, then let's check the total number of shares outstanding, whether they grow the number of shares. But I can see here over the past few years, they only grow their share counts very little. It's not concerning. Moreover, free cash flow per share is rising. So this shows that the free cash flow is doing very well as compared to the share growth. Share dilution rate less than 3%, free cash flow per share rises. So in summary, in terms of my red flag analysis assessment, I think it should be okay, except the share price we don't have data. Other than the DSO data, okay. Related parties transaction is also okay. No, inventory management not meaningful because it's a survey-based company. Except like goodwill is a large goodwill, but the ROIC still above 10% and steady. And no contingency. And the free cash flow is more than dividend paid and share buyback. And the free cash flow per share also rises. I would say this company is quite clean in terms of the red flag analysis. Okay, in terms of valuations, optimism, now the optimism is 41%. When I was created, when I created this case study, it was at below green. Then I didn't know the share price rose so fast. So yeah, if not, this could be a opportunity for to consider. And then the midterm optimism, as you can see here, is also at 48%. Okay, this company always have high valuations. In we look at price over cash flow valuations. So you can get this data for free from Morningstar. I put a link here. So as you can see here, currently the price to cash flow ratio is 83. 83 is very high on absolute basis. Is also high as compared historical average. Yeah, I noticed that Australian company, right? Australian technology company always command high valuations. So because of scarcity, because it's not easy to, not many technology company in Australia. There's a scarcity premium to Australian tech company. Uh, yeah, in the past, I used to have another tech company in Australia, a company called Pro Medicals. Because of valuation, I saw everything, but it's my regret lah. But the company after that 10x. So I should keep holding to that company, even though it's a high valuation. Uh, I think I will trim. If let's say I want to sell, I will trim the company, but for me, I will still holding to this company. Yeah. Okay, this company, their in terms of PEG, let's calculate the PEG. Sales in 2025 expected sales to be 179 million US dollar. Then the growth rate in sales will be about 14%. But if you look at the sales going forward, it's a 20+% because logistic industry is still young in terms of digitalization. So there's a lot of room for growth for this company. So optimize net income. Let's assume that the company can achieve 35% margin. So how I know 35%, this number because I feel maybe I will take Microsoft software profit margin. It's about 30 to 40%. Let's put it 35%. That's the amount the company can achieve. Then if you look at this optimized net income, uh, then you compare to the market cap, you get the PE 4P of 90. 90 divided by the growth is by about 6.9, which is expensive, the PEG. So if you have to wait the PEG to go to 1, uh it's not it's a quite a long wait. You never know. You never know the share price will drop in the future, but it's not easy to get into this company. So the easiest way is to use optimism chart lah. Then let's say it's below 25%, then the company is wonderful. I think it's a worth an entry. Or you can also use a technical analysis. So I put in the midterm optimism here. Midterm optimism at 0% is 80 Australian dollar. Then the 25% is 99 Australian dollar, 50% 1 to 1 Australian dollar. As you can see right now, it's near the 50% midterm optimism. So I would say anything below this line, or anything at the 90 Australian dollar is an attractive entry price for this company. Although the PE is high, price of cash flow is high, but buy in small amount, huh? But we never know it will go lower, let's say. Yeah, but because this company can grow their sales at 10-20+%, is there's a hefty valuation price tag. There's a hefty price tag to it. Yeah. Then let me take a look at your questions. Are there withholding tax when investing on Australian companies? What about franking dividend? Okay, I do not know whether this company dividends is frank. Let's say it's frank, then there's no withholding tax. But let's say it's not frank, there's a tax behind the Australian dividends company. Due to question from Kasim, due to large goodwill, what is the operating cash flow over equity? Goodwill should be concerned. Yeah. So yeah, made a good point. Over here, I compare the operating income over invested income. So it's quite stable. So it's not a major concern. My concern would be if let's say it's dropping down. So in terms of to answer your question, you can actually replace it with your operating cash flow. It is also okay. And but if I check the operating cash flow, let me go back to the okay. If I compare the operating cash flow and the net profit, is quite stable or it's quite steady. So there's no sign of dropping operating cash flow or net profit. So I believe the operating cash flow over the equity should be quite stable for this company. There's no sign of decrease. So to me, it's not a concern. Of course, uh, we have to follow, have to be mindful of this company. Let's say one day, they because the company has been acquiring other company, it will be a concern if those new acquisition no longer deliver, then then uh then the profit will take a hit. But usually, if you ask me, that is usually a good time to enter into this company. Because why? Because let's say they have to write down the goodwill, some part of goodwill, then usually uh that means the share price will take a hit. But I think the business model is still very strong. It's still subscription business, still high, what do you call it, subscription rate from the customer. So retention rate also very high. So I think it's not me a concern, but has to watch very closely on this data. The only problem is the goodwill and the key man risk, the overall dominance of the chairman. But other than that, and despite high valuation, I think should be quite okay. Yeah. Okay. If not, I'm not sure. Okay, if not, I will go to my last case study. This last case study is a Chinese company listed in Shanghai. Polaya is a young, high growth company in Shanghai. Okay, they make and sell cosmetic products. A few categories of products: skincare, makeup, body and hair, and high efficient skincare. But their major product are skincare, huh? So Polaya is designed for young white collar female customer. This is the price of their products. They also have products for oily skincare for college students and young female customer. Price slightly lower. And you also have a makeup products, uh, body and hair shampoos product, and collectors. Okay. These products, this company, you most of their sales come from e-commerce platform. But they also sell through offline, through pop-up booths, department stores, all this. And this company is the one top spot for 3 consecutive times. You can see here, it's the only Chinese brand to enter top 3 in the Tmall, the Alibaba e-commerce platform beauty rankings. So as you can see here, 2023, 2024, Paul Laya is the number 1 in amongst the Chinese consumer. And especially recently, a lot of Chinese consumer are switching to their national brand, domestic brand. It's a tailwind from this company. Then if you look at these are other overseas brands like L'Oreal, Estée Lauder, uh, and some are SK2. But in the Tmall ranking, Paul Raya has been consistently be number 1 for Chinese cosmetic products. Auditor opinion, unqualified opinion, true and fair. And the auditor is not Big Four. The auditor is come from the Pan China Certified Public Accountants. But this is actually this is the largest and most reputable accounting service provider in China, and he has been there for a long time. So I'm not too worried. How I know they are largest and most reputable accounting firm? I asked ChatGPT. I asked the Perplexity AI. Tell me more about these accountants. Tell me more about this auditor. Are they huge? How big is their influence? Then it tells me that this auditor is actually very reputable in China, so I'm not too worried. And in terms of AFA, EPS, ROE, all are very good now and also rising. Cash flow also positive, rising. NAV per shares rising, positive. Net asset value is a 27% of the assets are in the debt, but it's less than my 40% benchmark. Dividend per shares are rising, revenue are rising. Also, this company has a almost perfect AFS score. In terms of margin, gross margin 70%. So as you can see here, over time, the gross margin rising and rising. It shows that this company has some pricing power. It can increase the price to their customer, or it can also manage the cost very well. You can see here, in terms of operating and net margin, also double digit can increase over time, which is good. Quality of earnings are at 71%, 82%. There's a decline, but not to it still be by above 50%, which is okay. So so I want to check why their quality earnings has been dropping. So I got to go to annual report. So I check. So I put up the operating cash flow statement. Then I realized that this is mainly due to company fork out cash to pay their supplier. So to me, it's not a problem. Huh? They fork out cash to pay a supplier. That's why they have a drop in the operating cash flow. And return on capital. So return on capital, okay. What would be the problem? Maybe some of you may ask. The problem would be, let's say the company cannot collect cash fast enough from their consumer or customer. Or for example, the company keep lengthening the credit terms to their customer, and the company cannot pay back their cash, then that could be a concern. Let's say there's a decline in the operating cash flow. But to me, the company pay cash to supplier, there's a drop in the cash flow, then it's not a concern. Okay, return on capital, more than 20% and rising, so very high return on invested capital. Net debt, this company has more cash than debt. You can see here, minus 48%. So it is wonderful, very strong in balance sheet. Dividend payout, sustainability, dividend per share in brown, less than the free cash flow per share in green bar here. Payout is sustainable, and payout is also less than 50%. In summary, the financial numbers looks good. And in terms of business model, this company sells cosmetic products and is done via sales through distribution channels, mainly on the e-commerce channel. So so I would say their business model is transaction based, and these products are consumables. Once you finish a skincare product, you will buy again, so which is good. So the lifespan is not long. So how a company business model value chain looks like, you get the raw materials from the supplier, and then it can direct selling on the e-commerce platform to the consumer, or via the distributor or third party like a department store or other distribution channels or other outlets. Direct sales, online direct sales make a large part of their company's revenue. Skincare product made the largest sales contribution, is about 82%. The makeup and the body and hair are smaller percentage. These companies are still majority of the sales are still coming from China. So mainly East China, the more affluent region, Shanghai, Hangzhou area, East China. You also have other part of China, which is a smaller percentage. And overseas is and Hong Kong about 12%. No customer concentration. Top 5 customer only accounting 15% of the sales. There's no single customer account more than 50% of the sales. In terms of economy mode, I would say this company has created some brand recognition and loyalty in mass market segment for cosmetic product. That's why they are ranked number 1 in Tmall cosmetic product range ranking. And I would say as more this product getting more popular, loyalty grow, it will continue to gain more market share. And it also has some pricing power because their gross margin are also rising. No consumer switching costs, consumer can switch to other competitors if they want. No network effect. Low cost advantage, I would say, this company as their goal bigger, they can lower their cost of production. The unit cost per unit become lower, and this will give them the economies of scale. Oh, no efficient scale here. Okay. Risk. Of course, there's competition. Cosmetic market is competitive. So a lot of you have, not only you have domestic, you also have international competitors. So this company must maintain their strong R&D and marketing in order to stay ahead. Industry risk, this market is fragmented and consumer can easily switch to other competitor products. And also brands has to continue to launch new products, and they have to keep up to the pace. So there's some industry risk. And this company, how they got popular because of influencer in the they they have this key product last time. It's called the bubble mask. They have Li Jiaqi, the influencer Li Jiaqi to market the product. That's why during COVID time, the sales become booming. It was good before COVID, but it become even better during COVID time. So that's why the uh, the company became popular. But of course, this company has to continue to put in the marketing expenses, R&D expenses to stay ahead. Other risks, I would say low. Huh? Growth driver, I would say uh, company can continue to expand their product portfolio to meet different consumer needs. And also, company will continue to can what they can do, they can expand internationally to fight for bigger market. And also there's a continual rising demand for Chinese domestic brand who also spur some sales for the company. So this is to show you the rising the skincare market in China continue to grow at 10% CAGR over the next few years. And also you have a rising middle class in China. Then and these middle class people, working female adults, will continue, will also give them some market, uh, and will demand some products from this company. So in summary, business model is transaction-based. Skincare direct sales via the e-commerce platform are largest sales contributor. Majority of sales are still in China. There's no customer concentration. Company has a moat in terms of brand and low cost advantage. Some competition risk and growth driver is about expanding the product portfolio and market expansion. Okay, let's analyze whether this company has some red flags. In terms of days, sales outstanding is very low, 15 days, meaning the company can collect cash from their customer in less than in about 2 weeks, in less than half a month, which is good. Inventory management, because this company sell products, I will check the inventory management is quite stable, 84 days, and also declining. So there's no sign of inventory overstocking. I'm more worried, let's say the company, their inventories keep rising and rising. It shows that maybe the company product is no longer popular. Why why the inventories keep stocking up, but it's not the case for this company. In fact, it is falling, meaning I would say, wow, there are more in demand for companies' skincare product. Okay, share pledge. About 4% of their shares are pledged. From the annual report, as you can see here, the founders of the companies pledge their shares, but it's just a 4%. To me, should be okay, huh? It's less than my 10% benchmark. Related party transaction, no significant related party transaction. Okay, let's analyze the earning and asset. This company, large part of the asset are cash and cash equivalents and fixed asset. In this, as you can see here. How about the other items? The other items are not that significant. There's no loan provided to the consumer. Deferred charges is also very small. So it's not a concern now in terms of asset and earnings analysis. Commitment and contingency. Okay, this company has put some important commitment. What they say they will carry out expansion project on R&D. So which is good. This will bring in future sales. And in terms of contingency, there's no contingency. Shareholder capital and dividends. As you can see here, free cash flow per share is free cash flow is here, not per share. And the dividends is here. Most of the time, the free cash flow is more than dividend, but paid the share buyback is also very little. And the company did not issue any stocks over the past 5 years, but they pay back dividends and buy back shares. So they return more capital to shareholders rather than asking for capital from shareholders. No shares, no new shares issuance. Free cash flow per share also rising. So in summary, I think no a big concern for me in terms of red flag, whether it's quite clean for this company. Optimism. This company, the optimism is quite low, about less than 25%. And it was just listed in 2017. It's not a long history. If you look at the CR, it's only 13% with very low R2, 24%. So not a high confidence in terms of the share price growth. But I think if you look at this, it has been hovering around this region, 80 renminbi region now. Midterm has been downtrend, not a good sign. So it really depends on the individuals. Maybe later Dr. T will explain on this. So it depends on you. Let's say you are more aggressive, maybe now is the best time to enter. But let's say you are more conservative, you may need to wait for the midterm CR to turn positive to enter into this company. Okay, in terms of PE valuations, now PE is sitting at 20 PE. Is is quite low as compared to their historical average of 57. In terms of PEG, this company can grow their sales by 15%, 10+% moving forward. And assume that this company can optimize their earnings at 15%, I will get the net income here. Use market cap divided by net income, I get a PE of 17, 4P of 17, divided by growth is 1.2. So I would say this company PEG it's quite fair between PEG of 1 to 1.5. So uh, it's wonderful company at the fair valuations. Technical analysis, you can see from here over the past 5 years, it has been hovering around 80 to 100 renminbi region. And the long-term optimism is below 25%. I would say this is quite a good entry to enter into, let's say, want to have position in the Chinese cosmetic companies. I think this is a good time. But it really depends on individuals. Some of you are not confident with Chinese market, it's also fine. So yeah, and they are also growing their sales now, moving forward. Okay, so from can you hear me? Okay, I hope you guys can hear me. Okay.
Okay. Can.
Okay, suddenly my microphone has some problem. I got a warning message. Okay. Okay. A question from Eileen. How do I compare Polaya with Jaya Biogen, especially the risk and rewards potentials? Okay. Both companies has been at right now at an attractive valuation. I have position in both companies. Polaya is more on the cosmetic products. It's more on the skincare product, but Jaya Biogen is more on the uh, uh what do you call it? Collagen mask product. Uh, so both of them indirectly they are competitors. Polaya is the number one in China. Jaya Biogen is not number one. It's a top few for the but their Biogen is more on the sub market of the skincare product. It's called more on the skincare repair, uh the recombinant collagen product. Is a more specific market. And also Biogen, it has exposure to medical industry. So, for example, those medical industry, those patients, they have a wound, they have an injury on their skin, on their body. They can apply giant biogen product on top for the fast skin repair. Also, it's more, they have more business with the medical industry. Poraya is more on the cosmetic, it's not with the medical industry. So in a way, they are indirect competitors, but they are operate in a different sub-segment, I would say. So risk to reward both are at attractive valuations. But in terms of reward, I would say Jaya Biogen will be higher reward because Jaya Biogen are still small. Their growth rate is 20+% as compared to Poraya 15%. So the growth potential for Jarubin is higher lah. But that's my take. But we never know. Chinese market is changing very fast. You have to watch very closely. Okay, so with that, I think I almost come to the end of my presentation. So I think if you have purchased a course material today, you will get list of my models material. So you will have my updated watch list, top watch list as of 2025, this quarter, this half a year. And you always get this material like how do you use AI to help in your investment research. And I also added this, some of you are new students, to help in to speed up your learning. I included all my key summary, key lesson from BA1, BA2, BA3, BA4. I put in one PowerPoint to help you to guide you on or what are the list or items I look at now. What are the least financial ratios? So I all in one presentation. And I also included what are the past lesson from Olympus, Wirecard, Luckin Coffee, Andron, and how do we help us to make our investment screening better in the future. So this is a lesson learned from. It's a good read. Please uh, feel free to read into these PowerPoint materials I made. And the uh, next 5 are the updated list of companies with poor quality of earnings and cash flow issues, dividends pay more than free cash flow, inventory management risk, whether the company growing loans receivables related to their asset and sales, receivable management risk. So you get list of the companies with some red flag from me, and some article for you to read about it, portfolios in listed company, different kind of reporting standard for treatment of asset, and ROE, how can it be misleading? So these are latest material, updated these materials. You will get, yeah, if you have a course material today. Okay, I think with that, let me see whether you guys have any questions. Okay, question from Linton. How do I use standard deviation to measure historical PE and expensive or just compare PE and peers? Okay. Good question. Okay. How do I use whether do I use standard deviation? Look at whether is it 1 sigma or 2 sigma, one standard deviation. Okay. To me, I use visual lah. to me, investing is a art. Okay, let me take a look at this example. Okay, so what I will do here is that I look at what are the past historical average. Then I check, are they in the lower range or upper range? So it's enough for me. I don't go and measure whether it's a one standard deviation or two standard deviation. You can do that, no problem. Uh, but it requires some mathematical calculation. But to me, I just use it visually, because to me, investing is an art. It's a it's not like it's more art than science. You just look at it. Okay, if the valuation is cheap, and look at the TE price chart, whether it's hitting the nearest support zone, then I will buy. So that's me. Okay, whether do I use PE of peers? In some cases, yes. I I also look at the PE of peers, but I tend to look at the own company historical PE range instead of PEs of peers, because every company is different, business model is also different, competitive economy mode is also very different. So some strong company will have high PE, some strong weak company will have low PE. So it's very hard to compare one to one. So just compare historically with the same company and check whether are they in a high range or low range, and use technical analysis to help you make a better entry. Yeah. Okay. Okay, question from uh Gan. Will revenue guidance by issue by Novo Nordisk now to this percentage affect the business in long run? Does this also mean immobilized obesity drugs and diabetes does is losing market share to Eli Lilly? Is it a red flag? Okay, good point from Gang. Yeah, actually I have position in Novo Nordisk. I've been aiding recently. It's a wonderful company in a growing market. I think yes, they have been losing market share to Eli Lilly, but there are only two players in in this market, Eli Lilly and Novo Nordisk. Yeah, of course, Eli Lilly is a stronger company at this moment, but I'm not too worried about them because the diabetes market, the insulin market, the obesity market are growing, and then there's still a long runway for these two companies. So the market is like the market pie is growing. Just that Eli Lilly taking more market share from Novo Nordisk, but both companies are growing. So I would say, given the recently weak guidance, Novo Nordisk is very attractive. Oh, uh, I think the P is only 10 plus, but they cut down their guidance to 14%. 14%. Usually this company can beat their top end of their guidance, 14%. So I think currently I think it's at the attractive valuation. But please do your own due diligence. So I think it's an attractive buy. Reminded me of the Meta case. Meta, in 2022. Now Meta also give a very strong guidance. Yeah, since I ever introduced this case study on Meta platforms, now has been about 6x or 7x already. So yeah, I think Novo Nordisk uh could be the same, could be similar, but that's my take. Yeah. But maybe of course uh Novo Nordisk, a good thing about Novo Nordisk is the big company has a strong portfolio of patents, so they continue to innovate. Is it a red flag? I would say yellow flag, because they have been losing market share, but I think the whole market pie is growing. Just like cloud industry, the whole market pie is growing. Just that who takes more. So right now, for example, Microsoft and Google has been gaining more market share in uh, cloud business as compared to Amazon. But because Amazon is big in the first place, but I would say Amazon, I would say Microsoft and Google has been aggressively earning more market shares. Yeah, but the whole market is growing. So to me, it's not a concern. Yeah. Yeah. Okay. Okay. I think. let's see whether you guys have any question. Yeah. I remember Gun, you asked me about United Health sometime. If you, United Health, I'm not too sure. United Health is a good company. Insurance market is also always growing. But I think in the next 4 years, uh, there could be some bumpy road ahead lah for the United Health. But overall, I think United Health will recover, but just that it will take some time. Yeah. Okay,
Okay, I think
can
seems like
I
no
think
further
Dr. T, I think
question.
that will be all from my side.
Yeah. So my plan this way, Dr. T will give a bonus talk. I also kind of align with Kin Lim team today because his two case studies, we call it young growth giant stocks. So in case you say, Dr. T, two stock not enough. Okay, you can get hundreds of them, right, through the auto web. Of course, not as in-depth as Kin Lim gone through, even beyond the 8FA and so on. But I know you're exhausted. So my plan is to give you a 10 minutes break. So come back at 3:10 and I'll show you how to actually, learn further. Okay, so let me save the recording first.